That's me. Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move. Big money, big moves.
Disruptor, what's going on in the market? JT,
Hey man, what's up?
dude, what the hell? We knew this was coming. This is insane. We kind of called it, I think, a couple of days ago that these, I think MM was calling it yesterday too, that the minutes are going to come out hawkish because Kasari was saying QT. It's exactly what happened. Want to just give a brief explanation? What you see today, KT?
I think they came out exactly like how everybody was expecting, and whatever drawdown that we saw today, I think it was mostly like those the anxious retail sells that we saw, and it's not mostly hedge funds is what I think, because how I was interpreting the call flow. Yes, there are a few hedge on QQQ here and there for 114 going to OPEX, but all in all, the Fang and all these are showing some divergences to the upside. So tomorrow we might see some bounce back again, Rahul. That's what I think, because everybody knew how hawkish how these Fed minutes would be. It's mostly, I would say, kind of priced in at this point. So um, the market is known to do things that are very contrary to everybody's beliefs, right? So I think there will be a bounce tomorrow. I did get some a few calls, but I did hit that SPX put at I was seeing those Fed minutes come out. I was like, okay, this is bearish statements all over, and there will be some selling. And I did buy the 47.50 put on SPX at $1.50. I sold them at $4 plus, like $4.80, something like that. But they closed at $48.50. Would have been a massive win for me, but I'm just happy with what I got today.
Yeah, no, totally feel you. If anyone has questions, feel free to come up and speak. We're happy to take them. I don't know. We'll give you the best answers or perfect answers because no one has a crystal ball here, but we'll definitely try to. I do agree some of this was already priced in, and the reaction is always a little bit more exaggerated than in reality what is happening. But one thing I'd like to ask is usually the FOMC reaction, the first one you typically get is a fake, right? So do you think, and also another thing I'd read, again, this is a theory, it's not, don't quote me on it, anyone, but someone, I forget who tweeted this, a big account I was reading earlier was saying this could also be a fake out by the Fed using QT to do the job of what rate hikes would have done anyways. Because, dude, to go through with QT and rate hikes in this type of year when they've been so dovish and accommodating and they realize how fragile the economy is with the global pandemic, it would be like historic. Like that would be absolutely insane. Not saying they can't. I mean, they can do whatever they want, really. But um, I don't know. I mean, I don't know if I believe that theory. That would be like a placebo effect, almost kind of just like getting what they want just by saying it. But I don't know. What do you think about that, KT?
I absolutely agree with that, Raul. Like I always play FOMC in a way where, like the first move is always the fake move, and that's the first move that we saw today into close, and then tomorrow is the real move, is what I'm expecting. And if you look at FOMC, really, it is nothing that we have not already known, and market always is forward looking. Like all of this today, I feel it was just plain noise that the Fed wanted to roll out. And another part is in the December FOMC too. They said they would do faster taper, but what happened in December? We were seeing that 120 billion balance sheet on the Fed by the Fed too again. So what are they going to do? It's all up to them at the end of the day. But as a price action trader, right? What I think is. There will be a bounce based on how premiums are looking, like how, especially if you look at the premiums for next week. I'm not in the weeklies per se. I'm in like position into next week on Facebook, Amazon, and I also bought Google shares today, about 600 of them, but for 2022. But
When
all
you're
in
doing
all,
this buying, KT, I think you spent a few million this week. I think you said you bought Amazon 500 shares 2 days
yeah,
ago, and then you bought Facebook 600 shares. Today you bought Google. Are you anticipating rebounds back in a healthy way or stay stable at least? Because I'm sure today has spooked a lot of people.
The main reason why I'm kind of getting into these is also because, like, I liquidated most of my Apple assets, right? Like, so I'm just sitting on a boatload of cash right now, and I see the opportunity on Amazon, Facebook, and today with that huge drawdown with Google. There's a little bit like again, I'm not going into going after Roblox because Nancy Pelosi bought it, because like, I never invest into those kind of companies. But Amazon, Facebook, Google, these are safe havens, man. Like, like even if SPX is grinding sideways and pinned the entire year, these stocks can go up, and Apple can go down, Tesla can go down. Like, like the maintaining that balance in SPX, and these stocks can rage this year. That's exactly what I think.
Yeah, being
So
free cash flow positive and stable businesses, I think they're going to serve as a good safety net for many money managers. I think one thing I'm more excited than I usually am for is earnings, because I think the great companies are going to start to distinguish themselves and the laggards will continue to lag, because the market we're in, I mean, some of these valuations, I mean, if you look at Square, for example, I mean, it's almost at its 2019 valuation. This is like I was gonna put out a tweet. If someone wants to steal it, you can, because I didn't tweet it. But what took 20 months, this expansion pretty much got wiped out in 2 days, and we've gone back 2 years almost in some of these big stocks. So it's pretty insane. I tweeted yesterday as it showed that we started the year last year celebrating SE cracking $200, and today everyone. Yesterday was the 1 year mark where it first hit 200, and everyone was panicking yesterday when it broke the 200. It's just crazy how things can you see both sides of the spectrum, and people are getting very emotional with come to some when the price action is very unhealthy. So definitely some crazy things, but I agree with you, KT. I think some of these big tech names will continue to I mean, what do you do, right? Like, if you're a money manager, are you just not gonna, like, what are you gonna do? You're not gonna just short all the way down, because even that could get eaten up at some point. You need to park your capital some places, and these are probably the safest businesses. But um, yeah, the fear is definitely real, man. Some crazy vicious selling.
yeah, I mean, I think it was kind of anticipated too, also, Rahul. Like, like I was tweeting out about Shopify the other day, where I was like, I think it was a couple of days back, where I was like, Shop is not holding any levels right now. Like, it's losing all these key levels, and buyers are not really stepping in. It might see under 1200, and then nobody really noticed that tweet. But then, like, after Shop really died, I get like 100 likes on it. So
Yeah.
and I'm like a perma bull, right? Like, I always want the stock market to go up, because I own a lot of equity in the market. So like, but the thing is, like, you have to look at these little technical setups in the market and try to assess your, I did read a tweet. There's a difference between catching falling knives and catching the right trades when the market is going down, and that's exactly what I'm trying to do. Like, like, when Facebook went down a lot, I bought it. Amazon went down a lot, I bought it. Like, Google dropped a lot today, I bought it. And the other, like, I've been pounding on Airbnb too. That 164 was one of the level, and then it's 155. So if it goes down a lot, yes, I will buy Airbnb too. And then there's Disney. Like, these are certain stocks that I'm like looking out for, and there's quite a bit of value, and they did not run as much as how Tesla or Apple did. Again, I'm not
Yeah,
saying just
Airbnb
because.
hasn't really run at all. It's gone 120 to 205 really, but that was about it. It's held its 140 levels pretty much since it IPO'd.
Yep, exactly. So these are what I'm kind of looking out for. Like, like, I'm not saying Tesla and Apple have to go down for these to go up. Tesla and Apple can very well flag the entire year, or year and a half, like what Amazon did last year,
Right.
and then like, that's essentially what I'm seeing, where I'm rotating my cash around for these for my 2022 portfolio.
Yeah, no, definitely agree. I do want to hear Jeremy Lin's thoughts as well, but we had some people waiting on some questions, so let's just get those real quick. Brandon, did you have a question?
I did have a question. I know you guys mentioned that you're expecting somewhat of a bounce coming into tomorrow. Would you say that includes stocks like tech stocks like Tesla, Microsoft, Apple? Do you expect to see a little bit of a bounce in going into the end of week?
I don't know.
Or
So I don't know if we can really say we're going to definitively see a bounce. I think, I mean, that's obviously a hopeful statement, just because the selling today has been, I mean, pretty harsh. But I think the challenge is whether we see a bounce or not. The biggest problem I see, and I'll let KT chime in as well, is that a lot of these stocks, as he mentioned, Shopify, I mean, SC broke its 40-week, again, 40-week, not 40-day, 40-week support. So the levels are just not holding for many of these growth tech stocks, right? So forget Tesla, Google, Apple, Amazon, blah blah blah. Think about like the next tier, right? So you have like C Limited, Shopify, Square, like those type of companies. It's just they're still trading at like pretty high valuations. I mean, it's definitely tough. I mean, Square's been dropped a ton, but some of these other ones still have fairly lofty valuations. So honestly, I don't know. It could be choppy. I wouldn't guarantee. I wouldn't predict a full bounce. I mean, Kate's probably watching the flows and money moving. I guess much more closely than I am because he trades at a higher scale with options. So, KT, I don't know. What do you think?
So when you're asking me about growth stocks like Sharp, SE, I'm not sure about that either, because like the main reason is, if you look at the weekly, I mean not the weekly, just the daily charts, you will see a clear breakdown of the wedges, right? Like they are very very clear breakdown, and the bulls are not at all strong at this point. But when you look at big tech like Amazon or Facebook or Google or things like that, they definitely have a to be reversal kind of thing where we can probably see a nice little bounce, and when these kind of bounce, we might see some of the growth stocks back too. But all in all, like for me, the main stock that I look for, the ETF that I kind of look for when I'm assessing growth is ARC, and ARC was extremely bad today. The close was like kind of terrible. Yes, there might be a dead cat bounce, but I wouldn't even consider that bounce tomorrow to play ARC going to the rest of the week.
Yeah, no, it's definitely going to be a tricky time, Brandon. Honestly, I think a lot of us are curious to see what happens. As I mentioned earlier, I'm pretty keen to see earnings to kick in because I think some of these stocks just need that catalyst to really change sentiment because the entire sentiment's really been driven off macro for the past 6-7 weeks, and I think if they can continue to show their I guess quarter over quarter growth and doing well, I think that'll really help to a certain degree. But to be completely honest, no idea how the selling kind of winds down. What happens? I mean, this is a we're not talking just interest rates right now. We're talking mass liquidity being taken away from a system or a market that was relying on it pretty much since you could say since '09, honestly, but realistically heavily since 2013. But it's also crazy because in that same time frame we've seen a massive secular growth trend in many different industries, whether that be cloud, fintech, or many of these other growth stocks. So it's not like these companies are not good companies. It's just uh, it- it's it's tough to call what's going to happen next. I mean, the market's run up a ton, massive liquidity got injected. The Fed was dovish the entire time, right? So I guess the best piece of advice I would say is be nimble, be definitely manage risk, and just keep a track of the names you own, what averages they sit off of, and how they're moving compared to other comparable names in that sector. Honestly, that's the best we can do right now because the selling is it's pretty violent, I would say. Hope obviously that's not a perfect answer because none of us really know what's going to happen, Brandon. But I don't know if you have any follow ups to that.
Well, the reason I asked is because I do feel like certain stocks, like for example Tesla, do have a lot of positive catalysts coming. With their earnings report coming, Giga Texas, things like that, where I wouldn't expect as much selling pressure to affect it, but it's obviously taking a toll on its price.
Yeah, I mean Tesla is a unique case because they're pretty much pioneering an entire industry, right? So with Tesla, the thing is the moves are very, I guess, quick and massive when they happen. I mean, it sat $500 to $600 the entire year last year until it had that big move. I think late in summer when it started running and it just popped really nicely. So, and the same thing happened in 2020 with the stock, but it consolidated for a few years before that. So Tesla, I think, what happens is, since there's so many catalysts, a lot of them get priced in together, and that's why you see these big jumps at once. Because, like you said, there's the gigafactory expansion. There's also record deliveries in Q4. Elon is supposedly done selling. You also have growth expectations that for this year coming in at 1.5 million to 2 million EVs. You also had the Build Back Better bill, which doesn't really Tesla doesn't rely on it, but it's just the Congress is more supportive of EVs than it's ever been, because Democrats obviously are a lot more like think greener compared to our last I guess set of leaders that we had in house. So yeah, with Tesla, it's unique. I think it's a talk to figure out the move, because there's so many different catalysts, and they're proven, they're doing well, they're crushing in all cylinders. But you can make the same argument that they're very overvalued, and Ford and XYZ companies gonna come in and eat some business. I don't believe in that, but the stocks definitely run up a ton, right? I mean, it's over a trillion now, market cap wise. So I don't know, but I'm a holder. I'm a believer in Tesla, so I'm hopeful that it continues going up. But who knows what's gonna happen near term? I see we have Eric. What's going on? Jeremy Lin, I know you've been. I called you up. What's going on, bro?
Hey Raul,
What's
nothing.
going on? What's your take, Jeremy? On can I call you Jeremy? I don't know if you're really Jeremy Lin, but I just love the name.
Yeah, I mean that works for me.
Okay,
It's
cool.
kind of just my FinTwit alias.
Yeah, no, that's fair. I was a huge Jeremy Lin fan back in the day. Probably still am if you were playing, but the league kind of shunned him for no reason. But yeah, go ahead. Like, what are you seeing?
So definitely some extended selling pressure, to the downside today. I was kind of trying to scuffle through the FOMC minutes. I didn't see anything too, out of the blue, other than the fact that they did say they were potentially looking at selling off assets off their balance sheet before they finished their rate hikes up. So that was a little bit of a red flag to me. And I think, there's algorithms that, Wall Street uses that literally trade off of rhetoric and sentiment throughout these minutes. So that can obviously, extend selling pressure, especially throughout a session intraday. Kind of when I just look at the technicals today, SPX came down and closed, exactly at 4,700 and change here, and it's sitting right above the 50 DMA of 46. What is it? 4669, which is an interesting, kind of an interesting pivot we saw in 2021. There was a couple times where there was a peak to trough decline in the S&P of around 5%, and every time it settled around that 50 DMA and then bounced back to new highs. I think every single 5% decline over the course of the year, except for the one in October related around the Evergrande crisis, followed that trend line. So that's one I'm definitely keeping an eye on. Until that breaks, I don't think I can make a definitive conclusion on where we're heading in this market. Another one is the VIX still under 20 here, which is rule of thumb categorized as risk on sentiment, right? So until that spikes above 20, I don't think I can make any final conclusions towards where we're going to head, at least in the near term.
Hey, Jeremy, you and I understand VIX probably pretty straightforward for us. You want to just explain that if an audience member is listening, what the hell the VIX means? I know what it means. Obviously I can explain it, but if you want to just chime in a basic definition so people know what that can do to the markets.
Yeah, so the VIX, it's a volatility index, and it kind of tracks, the spread skew between calls, the premiums on calls and puts. And it really has a big impact on how the options market, can change intraday, the ranges that we see throughout these premiums. So stuff tends to get more volatile when the VIX hops above 20, especially when it goes above 30. We see extended volatility, kind of what we saw in early December, coming right out of Thanksgiving. So right now we had a 3% sell-off today in the NASDAQ, right? But, the VIX is still under 20, so I can't make any near-term conclusions from that proxy. Kind of want to base something off KT was saying about these premiums that I'm looking at here underneath the surface. So today, obviously, some of my favorite companies that I think are still valued fairly cheaply. When I think about at first glance is Facebook. It's a large cap, high beta growth stock, but it's trading at a 23 PE ratio. And they just kind of brought in this metaverse segmentation that I think they will be able to monetize fairly well over the next couple of years. So that's kind of why I'm looking at it amongst these big tech companies. And so Facebook and Amazon, right? They have earnings coming up end of January, early February. So I was looking at some premiums, after those earnings calls, and God, were they still expensive? So that kind of leans me in the direction that maybe this sell-off did get a little bit overextended today, just because the skew I see on these spreads is still leaning, incredibly bullish. As I said, not drawing any complete conclusions from today, but kind of did look at today for a buying opportunity for some of my favorite names that I think are trading at multiples, criminally cheap to where the indexes are trading at right now. You definitely could see some extended selling pressure in these, high beta growth stocks that trade, even up to 100 times their current earnings. Raul, I think you mentioned that like some of these are waiting on like a narrative change from some earnings guidance, so that's going to be interesting
I
to
think,
watch.
yeah, the biggest thing I think that will help a lot of these stocks is not only the earnings, but also what happens is this next earnings cycle, you see full year guidance. So I think that will just add something, some catalyst for some of these names, because I don't know if people realize some of these are doing really well, right? So, I mean, there's the block of certain stocks that are trading a negative EPS and are going to continue doing negative EPS. And I think those are names that you're going to have to be careful in deciding if you want to allocate towards or not. But then there's some that are for example, CrowdStrike. I think it's free. I'm pretty sure it's free cash flow positive. I don't have the numbers off the top of my head or in front of me right now. But names like that, if they continue crushing quarter over quarter, they got crushed the last quarter because their growth rate dipped to 63% compared to the previous quarter. So the thing is, these companies get judged on every single metric to the T, right? So if they come in and do well and continue to showcase that they're able to, which because they don't need, people don't realize like with all these rate hikes and the information that you're getting from the Fed, it does impact the market from a liquidity perspective. But some of these strong companies don't necessarily need that type of capital to continue growing, right? Yeah, it's good to have access to it because if it's low cost of debt and you can grow at a faster pace, you're going to do it. But if you see the debt is rising in terms of the interest you have to pay on it, you're not going to borrow it. But if you can grow organically or continue to grow your business and through the products you offer, the business is going to continue to do fine, right? So, and you've seen that in a lot of the companies that are winners now went through this in 2013, 2014, 2016, right? Whether that be Twilio, many people here, I don't know if they were investing in Twilio back then. They lost Uber in 2017. That was supposed to be a huge red flag for them. Many people thought that would actually affect Twilio very negatively, and they're pretty okay out of that, right? Shopify, I think, it's been around for quite some time, right? So these companies that you're seeing as winners today have gone through the cycle of being in an environment where interest rates were over 2%. February 2020, the interest rate was, I think, 2.1%. And we hit a 52-week high at that time, right before COVID happened. So I'm pretty curious to see how the earnings go this cycle. And just again, I think it's important to keep track of those more than ever because people, I think, have forgotten to follow the companies closely because they're so used to stocks just continuing to go up. I mean, it's crazy to me. Some people have no idea how their companies report or when they report, or they don't follow it. They haven't heard their CEO speak. I think it's insane.
Yeah, I think you're spot on, especially with that point about how these companies in the cybersecurity industry don't operate at an extremely capital intensified way. Their businesses don't necessarily take a lot of operating costs to function, and they're going to align with secular growth trends heading into the next 2-3 years with a lot of these high tech modules we see coming out, whether it be Web3, crypto, or even like the metaverse theme, just artificial intelligence. The cybersecurity industry is going to grow along with these. So I think it's not necessarily the case that they're valued extremely richly. One thing I wanted to add was I saw a couple of these companies like Zscaler, Okta, and Crowd got overweight ratings today from Wells Fargo, which I thought was interesting. So definitely going to keep an eye on that, heading into the next couple of weeks.
Yeah, for sure. My next space is actually January 12th is on Crowd and Zscaler. I have a pretty good panel lined up for that. Markets Mayhem, Eugene, Brad Freeman, and Francis. So I'll be posting a link to that, the flyer to that pretty soon. I see we have Jay. Jay, what's going on? Night King, I know you have a question. You've been waiting. Just give me a second. I'm just trying to go around everyone. Eric, what's going on, Eric?
Hey, how's it going? Night King, you can ask the question. I'm not in a rush.
It's not more so a question. It's more so just kind of like, I guess, agreeing with a lot of what KT said, especially with Shopify. I think last year Shopify was like my number one P&L, and there are certain levels that you kind of play with Shopify, and it, when it goes, it goes, and then when it gives out, it gives out, and I think like the last 2 weeks of December, we noticed that, kind of like the 1450 area, it just could not get through that, and at that point, after they dropped, I think one of the funds just ended up dropping news how they were downgrading it or something. At that point, like you had to let go shop because it was just going to be a free fall at that point. And second point is just on our Facebook and our Google, just seeing how much revenue they add in year over year, just because of the ad revenue. Now with Facebook just doing the metaverse stuff, like that's a good place to put money into if you just kind of want to continue growing on stocks, just because the revenue is still going to continue coming, because a lot of mom and pop shops are going to still continue advertising through them until they find an easier space. And if you also look at it, Apple is trying to find its way in with some of the privacy laws they're trying to put in by trying to get Google and Facebook kind of like out of it, among other things. So, kind of going to those big tech companies, that's a good place to kind of like hide your money and just try and figure out, what to do with it. And then, the Shopify's, the Squares, and all that kind of those companies, like that's not a good place to really put money at this point. And just the last point is kind of like SPX, just seeing how the drop from yesterday was. A lot of tech companies really were kind of flagging, and if you look at Microsoft, Google, and even like SPY and SPX, they were at a basis where if we were going to get dovish news, they were all going to pop. But yesterday was a huge warning of it would have been a better day to just sit down today and just see how things play out before you even play any kind of money. But yeah, I would also mention with I was part of KT's group when he first started. He's a really, really great teacher, and I learned a lot from him. And now I'm kind of like self-sustaining myself on just kind of making on the side while I work. So if you guys are looking for somebody to kind of learn from, KT is the man for sure. So that's all I got.
Thanks, Night King. Yeah, KT's a legend. I was kind of surprised. So people started buying yesterday because Kashkari, who's one of the most dovish Fed members, this is something MM pointed out very early on yesterday. Was he's the one that started bringing up QT. So I was very keen to see the minutes before making any type of move today. Like I was tempted on SC yesterday, for example, when it broke 200, but I knew there was no support left for it once it lost that. And if with the Fed coming out today, if we what we expected to see was what happened. The stocks were bound to go down again today. That's exactly what happened, right? The rampant selling happened exactly around 2:30. So yeah, it's pretty crazy to see. I want to get Jay's take as well from just overall. I know Jay has a lot of experience in this, just in the market in general. But Eric, are you there?
Yeah, I'm here.
What's up, Eric? How's it going?
Man, it's been crazy. Yeah, it's been wild. If you're new to the markets, welcome to your education, I guess.
Welcome to a real market.
Yeah, welcome to the educational phase of dealing with this. I was just going to give a quick rundown of kind of just how I'm thinking of things, kind of what has happened in my account. Yeah, so the last few weeks, one thing that we had this real artificial, the market was really artificially up, like with some of, it looked like there was a potential bottoming out. But the one thing that I kept noticing and I kept saying is, wow, we're really not getting volume. This is really, again, it was that, Christmas time, New Year's time. So just seeing that was just like seeing a bottoming happening, but not seeing volume really there was starting to get me red flagged. And so I know I kind of posted my year end of where I'm at. And then Tuesday happened. And, long story short, I stopped out of everything. So I went pretty much all cash, and I'm waiting. I don't really have an edge right now.
Sorry to cut you off. Do you use a 5% rule, or what do you do for your stop losses in general?
Yeah, I mean, that's a great question. So I don't really use a stop loss rule. What really I was doing was I had my levels kind of set of saying, okay, because I had some long-term things and I had some short-term things. So I don't really use the stop loss rule, but essentially what I kept seeing was, volume picking up. And it was, again, if you saw Tuesday, it was across the board. There was something going on that was above my head and above my pay grade. So I don't use stop losses hard like that. I like to, I don't love having, a complete like, hey, move in, move out just based on what Peter is saying or, what the price is doing. I like to give my stocks potentially some wiggle room around that, especially if it's close to the moving averages of when I got in. But yeah, I kind of had some lines drawn, had some things that I looked at. And it just, it happens, everyone. I don't know what, I don't have any great advice at this moment to like, go back in, start buying growth. Now, let me also preface this too. I'm 26 and I'm working on a house potentially in the next 3 to 5 years. So my capital is a little different than long-term investors. Um, but yeah, for right now, I'm chilling. I think the best thing you can do is not try and I think what I'm seeing a lot of and the sentiment I'm getting is, oh, you've got to buy now, you got to buy now, you got to buy now. I really don't think that's what you want to do. I really think you need to either
I
wait
don't
for
see.
things to
Yeah, I
base.
don't see why would you not wait for Q1 earnings at this point? Like, what's the rush? I don't get it.
Yeah, it's Q1 earnings. Also, just like the way the market is, again, it's the shift to value. Um, and I know we give Jim Cramer a lot of shit, right? Like Jim Cramer doesn't know what he's talking about this and that. But you kind of are seeing it in the market of earnings are going to be rewarded, cash flow is going to be rewarded, and these multiples on some of this shit, it's just not you're not going to get the same multiple. I think the gentleman who was on talking about Shopify, it's okay to let things go. Now again, too, depending on the type of money you're running, also can factor in. You don't want to pay X amount in a taxable account. When you're not, you don't want to have that on your tax bill, but it's nasty. I don't feel like I have an edge in the market right now. So that's why I'm in all cash. I am in some cash flow strategies. One of them is HNDL. I think I've talked about that a few times on here. But yeah, I just mainly the sentiment I want to get out too is if you feel like you don't have an edge, you're not the only one. I've been doing this for a few years. I don't feel like I have a straight edge. And when you don't have an edge, what you don't want to do is force it. There's a great thing of like dollar cost averaging into positions. That's really smart. But again, I'm taking small swings. I took a small swing at Qualcomm today. I took a small swing at Devon Energy. Those did not work. So for now, I got to just let this play. I really don't have an edge in the market. And that's okay. Because guess what? When this is somewhat healthy too. This flush, this bearish sentiment, some of the indexes really need to crack. The big, Tech 5 or Tech 7 really need to get weak before we can get our next bull run. So the best advice I can give everyone right now, do not stress about this. Preserve capital as best you can. You are not going to time the bottom perfectly. If you're looking out 10 years, that's great. But if you're not, you really want to play defense. And that's, I've got a few people that I talk to daily about some of this stuff. You just, you're not going to time anything perfectly. So that's my spiel. And also, there's something to be said about preserving your mental capital too. If this is stressing you out a little bit, you just want to get cash really high, maybe keep some long-term, really solid positions. But if it makes anyone feel better, I got 100% cash and I feel pretty good. I'm not going to love the potential taxes I've got to pay next year, but I don't have an edge right now, so I'm not playing the game. So that's all I got.
No, I appreciate it, Eric. Thanks for joining in and listening, and thanks for chiming in as well. I definitely want to get Jay's take. I think.
Can I say one more thing too?
Go ahead.
Yo, what's up, Parrot? Parrot, we got Parrot on.
I didn't see Parrot.
Is Parrot gonna talk?
Yeah, Parrot, feel free to come up and speak. Yeah, we have a bunch of people on.
Talk about one of the realest on FinTwit, always posting his P&L, man.
Parrot's one of the OG accounts. Yeah, he was always posting his P&L from Feb 2020. We saw him hit 1 million. I think everyone was rooting for him. I know Parrot's a great guy. Yeah, for sure. Avi's listening in. He can't come up and speak. Shout out to my boy Sagar. Jay, I think you managed a book at Goldman. Correct me if I'm wrong. I'm not sure about exactly in depth on your career, but I know you have some great experience from the street. Can you just kind of chime in what you're seeing historically versus now versus how are
Sure.
you looking at things? I'd love to just hand over the mic to you.
Sure thing. I appreciate it. I've been managing money since before Twitter was founded in 2006 or when it IPO'd. Been various funds. Every time, whether it is 87 or the 90s real estate crisis or 98 Russian bond default or 2001 or 2008, 2000. Recently, you saw taper tantrums like 2018. Corrections are normal. Growth slowing is normal. What is not normal is how much the Fed's balance sheet increased and how much M2 increased and how much fiscal stimulus the government had to put into the economy because of this one-off pandemic. The U.S. economy really didn't even go into a recession. It wasn't a recession, it was a shock. And the type of stimulus that was put into the economy was what I would have expected, if GDP had been down 10% for an entire year, at least 2 to 3 quarters. So, we were at a point where, there's speculation in every single asset class. We're still seeing people bid, hundreds of thousands of dollars for JPEGs. And now, all of a sudden, you have people and investors, shocked that the market can move down a couple percent in a day. Frankly, it's not normal. I mean, it is very normal to see 2-3% moves, on a quarterly basis. And we went 18 months, not seeing moves like this because of the excess stimulus in the market. And there are opportunities to make money on both the long and the short side. You don't need to go to cash. Long-term investing still exists. There's still great companies like Visa and MasterCard you can own, right, for the next 5 years. But there are other companies, like we've seen, companies that people just piled into, right, like Affirm, like extremely highly valued SaaS stocks like Net, that are down materially and that could still continue to go down. And their names in ARK, in full disclosure, I'm long SARK, which is inverse ARK. I trimmed a little bit today, but ARK strategy is just so asinine in that they sold the better companies in their portfolio to buy small cap illiquid names, and they own 6 to 8% of some of these companies, so that if you short them, they have no recourse. Like, they can't sell out of them. Their positions are so big. So they created a quandary for themselves where when ARK has a big position in in a company, you almost want to avoid it in this type of a market where, today the part of the Fed's meeting that was a surprise was that they were going to potentially start QT right after the first hike, which could be March, April. Now, everyone thought, everyone on the street, Goldman, Morgan Stanley, Citi,
that's a very complex subject. I'm sure many of us understand it to a certain degree, but from the audience perspective, who has no idea what QT even means, you want to dumb this down? Like, think
absolutely.
About someone listening in, because this is, I think, really important stuff for someone to understand.
Absolutely. So, the first quantitative easing happened in Bernanke right after the financial crisis, 2008, 2009. There's QE, quantitative easing, 1, QE 2, Operation Twist, QE 3. What is QE? It's when the Federal Reserve buys bonds in the market. And when it buys bonds, it essentially increases the amount of liquidity available in the market. It's buying bonds from investors, right? It's buying bonds from pensions, insurance companies, endowments. When those bonds are bought, the interest rates associated with those bonds come in, and investors, what institutional investors have to do is they have to reallocate to riskier investments. So they might move into munis or high yield bonds and investment grade bonds. And as those yields come in, they have to move even further across the risk spectrum to dividend stocks, then growth stocks. Investors have been forced further and further out. There's over 15 trillion of bonds with negative interest rates across Europe, Japan, and investors who rely on interest rates. For example, pensions need to earn 7, 8, 9% to pay out benefits to pensioners. And if they can't get that in bonds, then they have to take riskier bets in private equity, venture capital, common equity, in order to generate capital gains to pay off the benefits that they are liable to pay. And we've seen more and more of this because of central bank bond buying. And so that's QE, quantitative easing. The opposite of QE is QT, quantitative tightening, where the Fed lets bonds on its balance sheet. So the balance sheet is now $8.5 trillion. That balance sheet is going to shrink as the Fed stops buying bonds. It was buying, 120 billion of treasuries and mortgage-backed securities in order to ease monetary policy. It will stop, not only will it stop buying, which is called the taper, it will allow these bonds to roll off its balance sheet as they expire. Because bonds all have maturities. If you look at the yield curve, you have everything from 1 month to 30 years out in terms of bonds with different maturities and associated interest rates. The Federal Reserve balance sheet, if the Fed wasn't buying bonds, it would naturally shrink over time. And what I think, what was alluded to today is the Federal Reserve is going to allow those bonds to roll off and maybe even sell some bonds, maybe mortgage bonds first, 6 to 9 months sooner than what was expected. So the sell side, which is Wall Street, banks like Goldman, Morgan Stanley, Credit Suisse, Citigroup, etc., was thinking that the Fed would accelerate taper, then raise rates 2 to 3 times, March, June, September, and then after, raising rates a few times, it would start reducing the size of its balance sheet by the end of the year. And I think the big surprise in the minutes, if you read them today, that came out at 2 p.m., and what we highlighted on our Twitter page is that they specifically highlighted the chance that they could start quantitative tightening, which is letting bonds roll off, shrink, which is reducing liquidity in the money supply, sooner than what was expected, and that is very negative for speculative assets. It's very negative for crypto because one of the big reasons why institutions got into crypto is because of the rise in M2 and Fed balance sheet going out of control. It's negative for crypto, it's negative for speculative small caps, it's negative for growth, it's negative for anything that doesn't generate a free cash flow or an interest rate in a shorter time frame. So high duration names are the most at risk here. And you saw not only was the Fed meeting hawkish, the payroll numbers today, 800,000 beat by like 70, expectations by like 70%, right? So if
Do we lose Jay? Someone want to confirm they're on? KT here.
Yeah, I think we lost him.
Damn it! I hate when people go on
I
these.
think we lost him.
Yeah, this happens to MM all the time. I hope he's not on Android because Android does this to people on Spaces. Hopefully, we can get him back. But yeah, that was some awesome stuff. I think we got some questions that came in too while we were listening into Jay. Hold on, I think he's requesting to speak. I want to let him finish if he can. Yeah.
So not only were the Fed minutes interesting. I mean, this morning we also pointed out that payroll numbers were much higher than expected, which is also hawkish. The third thing is that Omicron, unlike COVID and Delta, is not dovish because the Fed put is lower and we're seeing inflation, supply chain shortages. I was just at the CVS across the street last night, and there's shelves that are empty. I was picking up some gifts for colleagues. I was at some department stores, shelves are empty. And we've known about this for months, but you're seeing it, and the Fed realizes it. And guess what? Fed easing doesn't really have anything to do with supply shocks. But if you listen to any of the meetings, with Congress, senators, especially Republican senators, have put so much political pressure on Powell, and the Fed is more political than ever, about inflation, about this and that the Fed, has to act preemptively. Inflation is going to come down regardless. But Omicron has created a situation where, especially in Asia, where they have a zero tolerance policy for COVID, especially in China, for example, in Hong Kong, that you could see supply chain issues last longer than we expected, which could make it seem like inflation is sticking around for longer than expected. The Bank of Japan, fourth point, today, early in the morning, announced that they were potentially looking at prices for the first time since 2014 as not being below 2%, or at least inflation not being downward trending, because they have a huge deflationary force, which is their demographics. Their demographics have been much worse than Europe and the US for decades. and that has kept prices very low. And for the first time, they're worried as well. So we're in a weird situation where, the Fed has no choice but to accelerate. And the Fed isn't really worried either because wealth has gone up the most it's ever gone up in a period of 2 years. Real estate prices are up 20%, right? People have made a ton of money on crypto and stocks, right? Stocks were up almost 30% last year in the broad indices. I know it was 7 stocks leading the market, but that's where people's 401ks are invested, right? In the broad index ETFs. So the Fed doesn't really care, in my opinion, if small caps are down 5, 10, 20, 30, 40%, right?
Did we lose him again?
Yep.
Yeah.
All right. Hopefully we can get him back. I agree with a lot of what Jay's saying, though. Also with China liquidity, we were talking about this. I don't know if Jay's.
Oh my God. The
That's-
KHYB. If you guys want to
Yeah.
look at, oh my God, that thing is falling
Jay.
off a goddamn cliff.
Go ahead, Jay.
So, it should do something on Zoom because Twitter, this is why Twitter stock isn't going because their technology is just.
It's insane, dude. It happens to MM all the time. He won't come on Spaces with us anymore. He was
It
one of our
happens so
main guests.
often. This is the first space I've done in like 4 weeks. In a bit, for longer than 2 minutes, because it's just not worth the time to get on for everyone. The people listening, the people talking. If Twitter is if someone's listening, get this fixed. It's mostly with Android users, but just to sum it up,
It's mostly Android. Yeah, go ahead.
the Fed put isn't the same. The Fed doesn't care if small caps are down 50%, or if your favorite growth stock is down 80%, or if crypto is down 90%. What they care about is general asset prices, unemployment, price stability, and right now, Congress is looking at the Fed as an instigator, even though a lot of the supply side inflation isn't the Fed's fault. So going into March, I think we'll have continued volatility. The earnings season is something one can look forward to. Some of these names might pop that have been oversold. Growth names down 50, 60%. If they can show that their revenue and earnings outlook is the same as it was in the third and fourth quarter of last year, you could see some recovery.
I think we lost him again. This is literally what I was saying, Jeremy Lin, when we started the Spaces. Exactly about the earnings catalyst.
Yeah, I'm like so intrigued by what Jay has to say.
I want him
and
to keep finishing. Yeah, I just hate, I get so tuned in and then they cut him. They know exactly when he's about to, give us the best stuff. Jay, can he keep you on? Mic check.
I think he's rejoining.
All right, we lost you for 10 seconds or 20 seconds.
Sorry. So earnings season coming up is a catalyst that could result in some of these names seeing a brief recovery if, for example, their outlooks are the same as they were in the third or fourth quarter last year, but their prices are down 50, 60%. So something to look forward to. But until earnings season, there's going to be continued chop. And guess what? Hedge fund guys just came back from their 2-week vacations. Some of them have been working from home due to Omicron. They took off hedges going into the end of the year, and they're putting them back on now. The institutional guys, have no choice but to hedge. And the rotation is real. I'm talking to guys that are down 40%, from the highs, growth guys who work at smaller funds, and they're like, hey, what do I invest in? The names that have been looked at for 3 to 5 years aren't working anymore, and they're asking about shipping companies and energy companies and industrial companies. And some of these guys in the industry, they're young analysts. They're 29 years old. They've never seen a cycle before. They've seen some small corrections. They don't know how to react, and sometimes they'll react in a way that deviates from fundamentals. They'll react emotionally, and hedge fund investors are just like retail investors with a little bit more sophistication, tools, and access to information. They act, emotionally, just like individual investors act emotionally. So the opportunity is when prices go too far.
I think we lost him again.
Yeah, we did.
Sucks. Sorry for cursing. It's so annoying. All right, I think we got him back. Did we get him back? Mic check. Feels like I'm running like a production.
Opportunity is when prices go too far, and you'll never time it correctly, but starting to add a little bit, over the next 3, 4, 5 months in names that are great companies, MasterCard, Visa, PayPal, etc., you'll be able to get steals and buy companies at prices that you never thought were possible. And that's what makes a market. You have to be patient. Doesn't mean you have to go all into cash. Keep your core positions, but offset them with shorts, right? If you're long EVs, like Rivian was a great short. Like it hasn't made any deliveries, doesn't generate any earnings. It's run by a very young CEO with no operational experience. It is the least well positioned for supply chain. There are hundreds of really interesting shorts out there, and at least on the SPAC side, I cover 600 SPACs. Like their number of NAV SPACs with 1 to 2% downside, where you can park cash, and when they rally 3, 4, 5%, you can trim and recycle. There are names like CFVI that we've now made 150% returns with 18 round trips, right? IPOF 6, 7 round trips. You can make 30, 40% just going in and out of these names, and you know what the downside is because there's a trust value.
Oh my goodness.
His recovery is pretty good, though. He usually gets back in like 30 seconds.
Yeah. Have not seen people do that.
Yeah, I don't know. He must have like a way to reboot instantly because just like gets so frustrated.
So I think the trick is, to restart your phone, clear your cache, and it helps you restart the space a little bit quicker. I am going to hop off in a bit, but I just want to leave this with you guys. There are a number of ways to make money. From a special situations perspective, there are a number of preferreds, like REIT preferreds that pay 6, 7% that are higher in the capital structure than common. There are NAV SPACs. There are NAV SPAC covered call strategies. They're selling cash covered puts on SPACs. There are decent dividend companies. Energy industrial MLP companies that make money from tariffs. Like there are a lot of ways to make money without, catching falling knives. And, we'd love to talk about them on another space. I know I don't want to, I understand what it feels like to be in the audience, and I don't want to keep getting cut off. So I'm just going to cut myself off for now. And I appreciate Rahul pounding the table for having me on.
No, of course, Jay, and feel free to stay on as long as you'd like. I think we should probably do a plan space with Jay. Is Luca here? Maybe you can note this down. But Jay, let's talk. I think we should get you on from a macro perspective because I think these are the things that people. We run a space pretty much daily, Jay. I don't know if you know that, but we're usually on in the evenings, and we have some planned events tomorrow. We have one with Brian Feraldi at 12 p.m. So some are planned, some are kind of spontaneous, just to kind of. I just hate the notion of not coming on, even if the markets are down, because I think this is the time. I mean, we have a great audience, and I think everyone wants to kind of understand what's happening. I mean, it's fun to come on when it's bullish, but
no, this is more interesting for me. If I were an audience member, this is like when you learn. Even in life, exactly. In business, in your career, you learn when things are hard. You don't learn when you're cruising, right? Like then everything's easy.
Exactly. Yeah, that's why I'm happy to take questions. Like I said earlier, we might not have the answer because we don't have a crystal ball. But if you have a question, we'll definitely we'll take it. Right. So, Jeremy Lynn, hold on 1 second. I want to get to some of these questions. Kai Curtis, I think you've been waiting for a while. Are you still here?
Yeah, I'm here. Thank you for having me on.
What's going on? Thanks for joining.
It's a privilege to be amongst such intelligent investors in the community and to hear insights from others. Definitely going off what he was saying, I totally agree. I think that we're going to see interest rates this year, and I think that you're going to really see a lot of pullback from speculative assets. I guess I was just kind of wondering where you see value at the moment, because I personally believe that, as he said, cash flow assets with good margins of safety are going to be where people push their money to. Me personally, I've been looking at like AT&T, Intel, Walgreens, AbbVie, and Bristol Myers. But I was wondering if you had any ideas for where you're going to be putting money this year.
Yeah, for sure. I mean, I can definitely answer that, but I want to get some more people to jump into the answer. KT, we haven't heard from you in a while. Jeremy Lynn, if you want to join in. And Special Situations runs a specific strategy. The SPAC one he mentioned is, I know, one he runs throughout the year. So I guess everyone can answer this, right? I mean, for me, I guess I'll wait till end because I want to let these guys kind of chime in a little bit too.
For me, I try to park it mostly in the big tech. For me, the top three, I already loaded them up. The second ones, you did mention Intel, which is pretty good. I do want to see that the margin growth and things like that also growing in some of these names on Applied Minerals and things like that.
Mm-hmm.
These are certain stocks that I'm looking out for as well, and I try to diversify, right? Like I don't want to put in everything into one. I try to I also weight them, like usually on the big tech like the Fangman plus T, I'm usually very heavy about. I at least put in like 35% of my portfolio in there, and then usually it's around 20%. I usually hold cash for some kind of a black swan event like it happened in 2020. It really benefited a couple of times that happened, especially in 2018. Was not much of a drawdown, but I do hold cash 20% of that there, and then the chip stocks definitely there is a lot more growth to them. I'm looking into loading a couple of them. One is ASML, and the other being Intel. These two I find some value in there, I never usually go to the lower tiers at all. I know Rahul and Rahul really likes SE and Net and things like that, but I usually never go there. Palantir, all these are way too speculative for me, because of the amount of cash I put in also, and that's one of my main strategies there. But try to into what I kind of do is I try to get into 3 to 4 sectors and diversify there, and based on the macro right now, I like banking finances per se, so I'll probably weight them second this year. Chips is something that I really like, so I'll weight them equally with banks. So something like that. So that's how I kind of diversify my portfolio.
That's actually
Yeah,
a great point. Thanks for that insight, because with higher interest rates, banks are definitely going to do better.
financials. Yeah, I was gonna say that with interest rate hikes, it's the most obvious, I think, sector to kind of allocate towards.
Mm-hmm. I've been looking at like Citigroup, and I've been trying to find other ones with a good price to book value. It looks like Ali might be the other decent, but I don't know. It's hard. It seems like everything's way at premium right now.
I think one thing that KT mentioned in terms of the book that you're managing, like I said, KT spent a significant amount more than just this week, right? So I think it really comes down to the type of money you're putting in, your duration you want to hold these assets, also what sectors interest you the most. I always like buying things that I actually can share for. I don't know why people don't do that more often. Buying a stock should be somewhat fun too, right? You should enjoy the company, and like I buy Airbnb, but I also stay at Airbnbs. It's actually fun to see that business grow, right? Apple, I use an iPhone, I own Apple. Like it's just this doesn't need to be so tricky, right? Like people drive Teslas, they own the ship. So find things that you actually enjoy, do use on a day-to-day basis, because I think it'll be easy to keep up with a stock. But I think as KT mentioned, yeah, I kind of look into some of these more riskier growth names a lot more than KT does. And some of the names that I'm looking at right now, I haven't really added much this week. I mean, the most recent buy was SC at 219. CrowdStrike, I'm definitely going to keep an eye on. Airbnb, these are all positions I already have, so I'll just be adding more to them. Coinbase, or probably and Datadog. I don't have a position in that one, but very curious to kind of continue studying that business, because they've shown really good quarter-over-quarter growth, and cloud is a space that has done well for me over the years. So it's probably one of my favorite places to allocate towards. But honestly, I don't know if I'll be making any moves for a few weeks. I want to see some of these stocks get a base. I mean, they've lost all their support levels. And like I said, if earnings kick in, hopefully that'll be a narrative shift to a certain degree. Also, one thing to note, I don't know if people realize this, but the past couple Februarys, we've seen a market top. I think part of this is because people, I guess money managers will prop up the market to a certain degree. Then they can sell these assets at a price and use that money to pay taxes, which is in April, right? I mean, you saw this almost like to the T last year, where you saw the stock market hit a high in February, it tanked in March, and then you saw an extension of the tax season go from April to May, and you saw a quick pop again, and then again we dropped down. So again, I'm gonna watch that. So there's certain things that I'm just watching right now. I put a tweet out a few days ago on everything I'm looking at overall. But yeah, those are the stocks I'm looking at. But I wouldn't say I've bought anything anytime recently, or plan on doing so anytime soon either. But these are stocks that I already own, and I mean, some of them I'm losing money, right? Some of them I'm down a good amount. So it's a tough time to figure out when to jump in, but I'm in no rush. Jeremy Lin, I don't know if you have anything. Love to hear from Parrot as well. I think we've had him on for a while.
Yeah, I mean, it really depends what your risk appetite is right now. As Jay was explaining, with the recent spike in the yield curve, there's going to be a lot of tailwinds and headwinds that the market's going to deal with. So, even to the perspective that if the Fed were to start selling assets off their balance sheet before they rose interest rates, stocks in general are considered risk assets, right? So they could potentially underperform, maybe like a 10-year, 20-year bond note. So that's something to definitely keep in mind if you're looking for, a safe place to park your cash. But yeah, just from an equities perspective here, one interesting narrative I've been looking at is, the PBOC as of late has turned to a dovish tone and they've started, injecting liquidity into their economy. But they did do a 180-degree reversal on that last night. So I'm going to be monitoring that over the next week. But if they continue to support their economy, through liquidity injection, I might be looking at some China plays to potentially outperform U.S. equities. But that's still something that has not materialized just yet. So I'm kind of sitting on my hands with that trend. Large cap tech, definitely a place to look for equities on a safer standpoint. As I said, I think the best value large cap stock right now is probably Facebook. So that one's on my list. Other than that, I'm kind of just, using this to buy some stocks as for my long-term portfolio. With the volatility, though, just near-term horizons are kind of diminished from my outlook.
Yeah, I definitely agree. I think that Meta is probably the most fairly valued of all. I've been looking at the start position around 300. But I think really what's going to happen in this market is as the bond market goes up and the risk needed to make a good return goes down, you're going to see a big washout of these speculative assets and these NFTs, virtual land. I think that stuff that doesn't produce in the real world is really going to have this correction. But at the same time, I think the way to look at this is don't be scared of a down market because it's actually your friend. The most wealth in the world is created around that time. And if you're just in the mindset of being long-term and looking at dividend reinvestment as a play, you actually want bear markets. I think it's probably just most important to find companies with long-standing value that live in people's brains and that have the pricing power to take inflation and put it on consumer. And I think that's what we'll see the next, at least stagnant market, while others are in bear for the next 10 years. We'll see.
Yeah, I put up a tweet just right up here on our spaces on before buying a stock, what are some things and questions I'm asking myself. So that's definitely a good point there, Kai. And thanks for jumping on and asking that question. If anyone has a question, please feel free to come up. Jeff, I think you've been on for a while and you had a question, but Parrot, I don't know if you wanted to share some insights. I know you've been doing this for some time and share your account, which is awesome.
Yeah, I appreciate it. I kind of playing the contrarian view a little bit, which is really killing me right now. But everybody kind of sees where the index is, and I do believe that we're going to have a correction in the index sometime in 22. But I think it's going to be a lot of these large cap names. They're probably not going to have a huge correction, but 15-20%. I can see Apple, Microsoft both coming down some because they've had nice runs, at least temporarily. So I actually sold those two positions a week or so ago, build capital to plow that back into some of the small cap, mid cap names that I do think are undervalued and oversold already. Now they could potentially still go down, probably will go down. They have the last couple of days, but I still think there's probably more value there next year. That being said, my biggest risk right now is I've probably got too many option plays open. I probably need to move those back into. Am I still here? Okay.
Yep.
All right, sorry. I probably need to move those into shares or back into cash, and probably will if we continue this sell off in the next couple of days, and just get some of the leverage out of my account. But for the shares, long-term positions, I'm not worried. I've got a long time horizon. I don't need the cash tomorrow or next week or 5 or 10 years from now. I'll be fine. So most of these names I feel pretty comfortable with. The biggest problem for me is I'm not adding money to this account, the one I share here. So in order to raise cash, I have to sell something. So that's really the biggest issue for me. I agree. I'm still long Amazon and Facebook. I think both of those are good good opportunities for next year as far as kind of safe havens. You're not going to lose a bunch there. And I still believe in the small cap growth stuff for next year. I don't think the Fed's going to raise 3 times. I know that what they're saying. I hear what they're saying. Hear the minutes, but we'll see. We'll see what happens. I think inflation is going to come in a little lower, hopefully, and hopefully the Fed slows down their raise. But honestly, a little interest rate increases are still going to be under 1% by the end of next year. I think that's still pretty bullish for equities in general in the long term. So.
Yeah, I mentioned earlier we were at 2% February 2020. So this honestly stocks have gone through this and run just fine with interest rates being up. I don't know if many people understand that fully, but these companies have seen this type of environment already. Many of these same growth stocks that we're talking about. So definitely fair. Parrot, I don't know if you posted your account today or your.
Yeah, it was ugly.
It
Another
was
ugly one.
yeah, I can't. Man, I think you topped a million, double top at a million.
1.13 in February of 21. That was the high. Hadn't seen it since. I hit. I crossed back and forth over a million. I think 5 or 6 times this year. So or in 21. So it's a crazy year. But it happens. And again, I'm a long-term investor. These positions are going to be here a long time. I'm not worried about them. They're going to be higher 5 years from now than they are today. So that's all I'm worried about.
Yeah, it's crazy how many long-term investors we've lost. You saw that tweet I put up yesterday, Parrot, summarizing the past 2 months on FinTwit. Everyone's an NFT investor now that was once calling themselves long-term. So I'm glad some of us have stuck around. Parrot's definitely one of the best on here, as well as Eric too. Of course, we have KT, Jalen. See, we have a bunch of questions coming in. Jeff, did you have a question?
Oh, one more thing too. Another name to throw in there. Chips Qualcomm. I mean, the Microsoft news is big. Like, keep that on your radar.
And also they have the contract from GM also.
Yep. No, I tried getting into Qualcomm today, and I was a little too early, but I'm not giving up on that one. So it's still on my radar.
With palm tree picture, are you still there?
And another thing that Parrot also mentioned that I would want to say is the minutes that were released today were from December, and anything can happen after the inflation numbers come out. JPA or someone might come out and say, well, the inflation is not as high as we expected, and things like that. Things might change, and we might have a snapback rally again. So just something to keep in mind, like have an open mind about what is happening around you and react to it.
Yeah, for sure. I guess Jeff with palm trees left. Tin Pot Investments, did you have a question?
Yeah, hi there. I just had a quick question about C to Parrot about his recent tweet on the Free Fire revenue numbers and numbers of active users. So I think I'm a long-term investor in the sense that if prices are changing due to macroeconomic chop, I'll try and ignore. But if there's a change in the fundamentals in the company, that's when I'll take a look at it. And I think in the latest quarter of C, there started to be a slowing down in the number of active users for Free Fire, the main sort of revenue generator for C. But in your most recent tweet, Parrot, it seems that in the latest quarter, those numbers have absolutely gone up massively and actually has broken the recent downtrend. I don't know, can you put any weighting into those numbers, and do you know where they've actually come from that tweet? And I think I'm mainly saying this because there's been a lot of chatter about C and the recent insane drawdown.
Yeah, absolutely. So that's actually came from Mr. Byside, also a great follow. A post I shared from him. I haven't talked to him about exactly. It says it came from a Bernstein analyst. The chart does, so you can see it on my timeline. But yeah, it appears. I mean, last report, the numbers really weren't bad. They were just a little flat, and everybody kind of panicked. At least that's what it seemed like, because that's their cash cow, right? That's what's paying for all the other growth. But it looks like from these numbers that Free Fire Max is actually doing quite well and surpassed the Free Fire, what little they lost in Free Fire. So it's actually pretty encouraging, I think, that they're going to keep growing. You'll probably see more of those convert over to Free Fire Max. I think some of the thought is that Free Fire is actually holding up pretty well. I think they're only down 7% as far as users go with the new Free Fire Max out. And I think some of that's attributed to older generation phones not being able to run Free Fire Max. So that'd be why less are converting. But in general, numbers look good. Yeah, they were. I think they were at 27.2 DAU million DAUs, which I think their high before was like 22 back in 2019. So I mean, that's a huge number. It's a big number there.
Yeah, exactly. So here's the graph of number of sessions. I'll just read out the stats, and I think you probably could assume number of sessions is proportional to revenue. So Q1 2021 was 5.6 billion. Q2 was 5.8, Q3 was 5.9, and then now it's saying Q4 2021 is 9.3 billion, which would be pretty outrageous if those are actually true.
Yeah, so like I said, we'll see if those come out when they actually report, but it looks like that's what they're projecting right now. Either way, I think they're going to be fine. I wasn't really worried about them at all anyway. I figured it would be short lived. I mean, it ebbs and flows anyway. So, but yeah, those are huge numbers if they come out reporting there. I think we're going to have a big upside.
Yeah, and one last question: what do you think of the entering into the sort of ride sharing? Because if that's anything like Uber, that's an absolute money sink.
Yeah, I'll be honest, I don't love it. Just from that same kind of thought process, but I'm not in that space over there. I'm not sure what the economics are in Southeast Asia where they're launching that, but they're basically getting into everything. They were already doing food delivery even before that. They've some food delivery partnerships and stuff. So they're looking to control the world, I think, and I actually like it. I like the ballsiness of it. I posted it the other day. I don't know if it was on Twitter or Common Stock, but I like the ballsiness of Forest, and I like what they're doing. So we'll see.
Yeah, you're basically getting an ETF in one stock. Okay, cheers. Thanks a lot.
Yeah, thanks for the questions.
Thanks for asking, Tinpot. Next, I think we have Luca here. I definitely like to hear from him as well, especially that daily rap he does. But we can take a quick question. Trembling with greed. Did you have a question?
Oh, hey guys, thanks. Thanks for letting me speak for a second. It's not really a question. It was just that what do people think is the likelihood that we rotation away from tech? Especially with interest rates rising, maybe the Fed is going to do 3 rate hikes this year, another 3 next year. I mean, you could see short-term rates hit 1.5. Anyone have any ideas?
I would say, don't you think part of this rotation has already started to happen? I mean, some of these growth stocks, if you're not looking at big tech, right, so take away FANG and Tesla and NVIDIA to a certain degree, a lot of these growth stocks have drawn down a good amount. Financials are up, energy's up.
Yeah.
And so you're seeing that rotation, I think, since November, really, right? So I think you're right. I mean, I would say you're seeing it already, hands on, like as it's happening. And I think maybe it's do we have MM? Because this is probably the best one of the best guys on here. If he wants to jump on, I know he's having some technical issues, so I don't know if he'll want to. But yeah, so I think part of it is already kind of happening. I don't know if KT, what you've seen from the options side of things, or Jeremy Lin, or anyone else really. Just feel free to jump on.
I mean, in my opinion, I think you kind of touched on it already. Is outside of a few mega cap names, we've already kind of seen that rotation, and a lot of a lot of growth, a lot of tech, a lot of everything, kind of under the water there. But yeah, I mean, I can see it happen maybe in the short term, but in the long term, I mean, everything is tech now. I mean, you can't get by without tech anywhere. So I don't think it'll be a long-lived move.
All right, I have to take advantage of this opportunity. I'm sorry, Trembling with Greed. We'll keep you on, but MM's phone is probably not going to let him stay on for more than 3 to 4 minutes. Sorry, not MM's phone. I think it's more Twitter rugging him. MM, you want to just take the mic for 90 seconds or however long Twitter allows you to be on here?
I think he's not a speaker on here.
Yeah, I don't think he's up yet.
Yeah, he's connecting still, so once he's on, we'll have him. But Trembling, does that answer your question to a certain degree? I think it's already kind of happening. I guess is your question, do you think it's going to continue happening, or is that what you're trying to lead towards?
That's more or less what I'm trying to lead towards, especially when you look at the multiples. I've been following just for the past year or 2 years, so the multiples on SaaS stocks. They are compressing. Totally agree with you, especially really pronounced in the last 6 months. But they went from being, in my opinion, I'll call it, they went high to now starting to normalize back down. But it's just, I don't know. It's just something interesting. Just caught my eye.
For sure. I agree with you. These rotations, I think, will be something to watch for throughout the year.
I'd say also, too, until the big, 5 or 7 kind of break down, the rotation's not done. My 2 cents. But I think you really need to see a good amount of weakness from those safe havens to really start figuring out if we're bottoming. Until then, it's, the rotation can keep getting more and more violent. But MM, go, wrap, see, what do you got for us?
Rip it, MM, till they run.
Yeah, hey everyone, we'll try to kind of keep this going until the gods of Twitter force me off here repeatedly, and then I just end up leaving because I can't get on anymore. But I dropped a podcast yesterday that talked about my concerns regarding quantitative tightening. I just want to elucidate that with a little bit of a metaphor. So you think of quantitative easing, it's basically like opening a spigot of liquidity, filling a pool, everything in that pool gets lifted up, the bid goes up for all these risk assets, rates go down across the board because the price of the instruments that convey those rates are going up. And so, for a while, it was good. And we saw a preview of what quantitative tightening and rate hiking looks like in the back half of 2018, in particular in December. And it wasn't good. And in fact, it was so bad that the Fed actually completely ended their quantitative tightening in the summer of 2019. It was only then the market was able to make new highs. So if QE is turning on the spigot to the pool, tapering is turning off the spigot, and QT and rate hikes are essentially draining the pool. And so we just got to the point now where the Fed is saying we're going to drain the pool. And in no uncertain terms, they're talking about balance sheet roll-off. They're talking about accelerated tightening. And we have to really be mindful of a couple of things here. The first is that it does not have the tools to battle inflation. They might say they do. And from a demand side, they certainly do. But when the inflation is happening because of supply chain issues in part, and really that's, I think, one of the biggest drivers here, they may actually exacerbate that inflation by driving up the costs of some of the components of that supply chain. If their debt costs go up, what are they going to do? They're going to pass those costs down the supply chain as well. So I don't know that necessarily taking out the lubricant from the engine that is the economy is going to have the intended effect. But ultimately, the minutes that we got out today and the trial balloons that we had yesterday from the Wall Street Journal and Neil Kashkari are incredibly bearish. They're basically saying that the mechanism from which this bull market was built on, and let's be 100% clear, I feel this is a liquidity-driven bubble. This is not a bull market that's primarily driven by the economy or by earnings. It's driven by liquidity. And if we were uncertain about that, we need look no further than the kind of reaction we had today to get some kind of clarity. That clearly the market is worried first about liquidity. Another example is when you get weak macro and the market seemingly inexplicably rallies. That's because the certainty of an abundance of liquidity becomes higher. And when you have the opposite of that, like a great ADP number today, parts of the market start to fall apart too, right? And so you can see that the market is addicted to liquidity, and it has been for quite a while. But most importantly, throughout the bull market, and this bull market started in March of 2009 or so. That was when the bottom was put in. That was when FASB told banks that they could mark their assets to whatever they want. I like to call it mark to make-believe, puppies, unicorns, and rainbows. If that mortgage-backed security is worth a penny on the dollar, all of a sudden it's worth $1, and the financial system is saved, and now let's just flood it with liquidity and sort of paper over all the fraud, the great financial crisis, and pretend none of these things happened and just go on living. There's only so long that kind of approach can work. You're slapping a Band-Aid on a gangrenous axe wound, and the law of diminishing returns is clearly in full effect. You have to be reflecting on how much stimulus has come into the system post-COVID, for example, fiscal and monetary. And if we net all of that out, and if we net inflation out, what does GDP actually look like? What do retail sales and all these other figures really look like? Is this an economy that can run without stimulus? We already know it's a market that cannot. So I think, the one thing that we have to look at, and Bill Fleckenstein wrote a great book about this, I think it's called The Fed's Bubbles or something like that, but essentially the Fed is the creator of bubbles and they are the destroyer of bubbles. They de facto inflate the price of assets, and they lower the cost of funding, and that has a latent stimulative effect on the economy. But it doesn't necessarily drive real-world inflationary pressure. Like a lot of that money that the Fed's putting into the banking system, it doesn't just trickle down on the bottom 60% or even the bottom 80% of consumers, right? It really stays within the financial system. That is to say, the transmission mechanism of Federal Reserve monetary policy is directly into financial markets. So that's why you see, mostly a synthetic effect. There are some real-world effects, like real estate prices going up because that real estate is tied to rates. But ultimately, for us as market participants, we have to take a moment to kind of reflect on what's changing here. Because if this is more than jawboning, and remember, the Fed does effectuate about half their policy outcomes by just saying things and kind of seeing what manifests, and if it fits their policy objectives, then they don't need to change policy, right? So we do need to be mindful that there could be some jawboning here, but on the other side, this is a Fed that is being pressured by both the Democrats and the Republicans to, quote, get ahead of inflation, unquote. And the tools that have don't really offer them that capability. In fact, as I mentioned earlier, there's some chance it could actually make certain components of inflation somewhat worse. So
one quick question real quick. Sorry to cut you off, man, but I heard your entire podcast. Great stuff. Check it out if anyone hasn't. I'm going to speak as fast as possible because I want to let him continue. You said one thing, that the Fed might not have as much incentive to stay as, I guess, dovish because some of the policies that are changing around the people in the Fed that can trade, right, in your podcast. You want to elaborate on that a little bit too?
Yeah, I mean, I was being, just a little facetious. I think there could be some truth to it, but essentially you have the Federal Reserve, unlike Congress, telling that their officials that they can no longer trade the market. Congress is still allowed to trade whatever they want. We saw those big Nancy Pelosi trades go out for Roblox and Google and other nonsense that they shouldn't be allowed to trade. But yeah, the Fed has been told they can't trade, and so I just was kind of joking, saying, hey, maybe they don't care anymore about the market because they can't trade it. I mean, I still think that the third rail of Federal Reserve monetary policy is asset markets. It's just that, look, I mean, we've had more than a double off the COVID low in March, April of 2020. And the majority, if not all of that, has been predicated on an abundance of liquidity. Once COVID, the sort of crash effect of COVID, and by the way, it's not just COVID that hit markets. It's not just the shutdown that hit markets. Let's be real. In late 2019, there were a lot of signs of fractures underneath the surface. There were a lot of problems in the repo markets, and the after effects of quantitative tightening were still being felt. So there was something that was going to come down the line, whether it was COVID or something else. This was an increasingly fragile market. COVID just gave cover to sort of say, okay, well, this is bad enough that we're going to intervene, and it happened, that crash, that COVID correction really happened around quad witching in March of 2020. A lot of these large market events happen around these significant options expiration events as well. So I don't think that's any coincidence. I think that was an inevitability, whether it was COVID or not. We were going to get a correction. It probably wouldn't have been quite that violent, though. So the Fed has an obligation not only to try to effectuate employment outcomes, again, somewhat limited in their capacity to do that, as you can see with the labor force participation rate languishing from one crisis to the next, never recovering. They have an objective to try to keep prices under control. As you can see, since 1970, the U.S. dollar has lost more than 80% of its purchasing power. So you could reasonably say they're failing on both objectives. But they have a third rail that is less transparent, which is, making sure asset markets continue to have this sort of stealth bid. And you could say, well, at least in that one policy objective, they're doing really well, right? The S&P of 666 in March of 2009, it's now trading at like 4,700. So mission accomplished, right? But yeah, this is the one other thing I wanted to touch on, because we have to countervail this with the other side of it, which is, look, I've said this repeatedly on Twitter. I stand by it. We have cyclical inflation. We have secular deflation. These are two countervailing forces, and they can exist at the same time. And what does that mean? It means that we have a debt supercycle that's gone on for over 4 decades. It is increasingly fragile. There is inordinate amounts of leverage in the financial markets, in governments from local, state, all the way up to federal and national governments around the world, as well as in households. So the other side of this is, how far normalized can we go before we create a credit crisis? And this may be what constrains Fed policy from anything resembling full normalization. They're going to reach limits probably earlier than they believe. I mean, I think the max Fed funds rate before they create a crisis is probably 2.5%. It really is probably that low. And so look at it this way, right? The 10-year bond, it's got a yield of about 1.7% right now. Let's say it goes up to 2%. U.S. government's got $30 trillion of debt. That means that U.S. government now pays $600 billion of deficit spend on their debt every year, right? Let's say it goes to 3%. That's $900 billion. The DoD budget's $750 billion, just to give you an idea. So that would force austerity. That's not exactly what you want to see. Let's say it goes to 4%. Some people are calling for a 4% 10-year. That's $1.2 trillion of deficit spend on debt alone every year. That absolutely forces curtailing other government services. So that's a big problem. And then you extrapolate upon that, because the U.S. government's certainly not the only holder of debt. There's over $150 trillion of debt globally that keys off the 10-year rate. So there is a limit to the elasticity of tightening of these policies, of how far they can go before they actually create the next crisis they have to respond to. So that's the other side. It's kind of a little bit of a rock in a hard place, because on the one hand, the Fed isn't really operationally configured with the tools that they need to try to improve supply chains. Listen, you can't really pump enough liquidity into the system that everything just starts flowing in the tangible world. That's not how that really works. If it did, supply chains would be magically fixed already. On the other hand, if they go too far on the tightening side, they do risk creating and exacerbating that sort of deflationary collapse of the debt supercycle. So they're really walking a tightrope here, and so are other central banks around the world. And I think it behooves us as investors and traders to keep a very close eye on what the Fed is saying and doing, not just like what their speakers are saying and what they're talking about in their policy meetings, but also what's actually happening in their open market operations. And they do post a lot of that. They're actually, to their credit, somewhat transparent, but also what's happening on the econometrics front, right? I mean, that ADP number gives the Fed more confidence to tighten faster, to accelerate their tapering, to maybe even do balance sheet reduction. If we continue to get strong econometric data, they're going to continue to put their foot on the brakes of their policy. right? And because they're going to say they're justified. Look, the economy's recovering. Now, obviously, you can look at all kinds of parts of this economy and say, no, it really hasn't recovered, including the thing I mentioned, labor force participation. You can look at real wages. You adjust wages for inflation. They've been going down for most people, which is not really constructive when their cost of living is going much higher. So, they haven't really completed the policy outcomes, but they have a lot of political pressure, and they have this sort of illusion that they've created that they can magically solve inflation. So, I think if we just go back to risk assets for a second here, if we talk about how stocks derive their value, one component of it is that there really hasn't been an alternative to stocks. For the longest time, and I'm talking over a decade, there really hasn't been a viable alternative. Like fixed income's kind of been on life support. You either have to go in with leverage, or you have to go in with higher risk, or both to get anything resembling a return that beats inflation. Well, that paradigm might be shifting, because if they are beginning to drain liquidity from the system, if they are beginning to raise rates, then we start to see some viable alternatives to equities in the fixed income market for retirees, which are the largest component of asset allocators, right? So that's another thing that we have to kind of think about. If rates are rising, there's more competition for stocks, and people might have a bit of a bad taste in their mouth if this thing kind of, if it kind of rolls over a bit. So I think there's a lot to keep an eye on. I think that this is a seismic change, if indeed it is more than jawboning. And QT, in my mind, has always been the death knell for a bull market if they actually follow through and really do run down their balance sheet. Not only because it drains the pool, so everything in the pool, all the stocks, the cryptos, the bonds, I mean, everything's correlated to one at this point. They all pretty much have their bid drop down lower and lower and lower. But on the other side of it, it really does eventually have real-world economic impacts and impacts on the credit markets as well. So this is, again, conditional. If they follow through with it, it could be the end of this bull market. It's not a young bull market. This is a bull market that goes back to 2009. We had a hiccup in 2020. We had a hiccup in 2018. They didn't really end the bull market as we knew it. They didn't really end the business cycle as we know it. So this is kind of a market that's been living on liquidity as life support since. And I think that's really important to consider, because, again, if you look at earnings and if you look at economic growth, they don't warrant the returns that we've had. And that's the real kind of truth, is that, once liquidity gets drained, a lot of things need to be repriced a lot lower. That the risk premiums change a lot across the board. And because, it used to be that bonds were a safe haven away from stocks, but now they're very correlated. Bonds go down, stocks go down at the same time most of the time. There's not as many places to hide either if we do see a kind of universal risk-off atmosphere, right? So be nimble out there. There's no shame in raising cash. There's no shame in having hedges on. If you were hedged into today, congratulations, you did well. It's one of the few Fed events where, instead of rolling off volatility, it ramped. And I think it's because it caught a lot of the market off guard. And we have a Fed meeting coming up in the back half of January. And remember, the back half of January is also going to be this month's window of opportunity for bears. A lot of skew is elevated. There's been a lot of put buying. There's a lot of insurance at the index level. A lot of basically bananas feeding Gary, as Jem likes to say. And what that means is that as prices get further away and as the expiration approaches, you get more and more of those passive Vanna flows from market makers that are essentially buying back these hedges that they put on. So they're bailing back in, they're covering shorts in the future. So there is a constructive bid that drops off completely after options expiration, which I believe happens right before the Fed. So there's a big yellow flag coming up the later part of this month, is what I'm getting at, just from how market positioning works, how options expiration work. I think it makes sense to be cautious. I know some market observers that have been in the industry a lot longer than I have are saying that this might be kind of the top. We're already starting to see it. I'm not quite at that point yet. I need to see the Fed commit to what they're saying, but if they do commit to what they're saying, I would agree with that assessment. We may be seeing the top, and it may be time to kind of be much more defensive.
And there we have it, folks. Market's over. No, I'm just kidding. MM, that was amazing as always. Please stay on if it looks like Twitter's allowing you more than you time, so that's good. Hindsight Capital or Hindsight. Hindsight Capital LLC or LLP. I don't know which business you associate with, but did you have a question?
So more of just to answer a previous question. So somebody asked about,
Did we lose it?
I think so.
Looks like we lost him. Hindsight, are you there? I guess meantime, while we wait, we haven't heard from Luca at all. Luca, anything to add or jump in on? I know you've been on for a while.
No, not a terrible amount to add. I think all the speakers have really absolutely nailed it when it comes to the Fed and really what those Fed minutes have indicated in so far today. Now, on a technical basis, I am just starting my nightly review on the markets, and what I do see is that in relative, you actually see that SPY did hold up quite a bit better than Triple Q. So I guess that's a net positive if you're trying to find net positives out of today. So I look at SPY and I look at that daily chart, and I see that it is still above that 50-day moving average, that simple 50-day moving average on the daily. So I am looking for SPY to hold that 50-day moving average throughout the rest of this week. But what I do not like on the SPY daily chart is I see that the MACD is working on a convergence back down into negative momentum. So if we get that crossover and more continuation to the downside, I fear that you could see a break of the 50 SMA. And also, we saw quite a bit of volume come in the day, above average volume when compared to the previous week and a half, 2 weeks on SPY. So that is also something to note. Now, I do look at Triple Q, and when I take a look at Triple Q in that 50-day, I definitely do not like what I am seeing here. But what I see today is that Triple Q on heavier or pretty lofty volume did break down through that 50-day moving average. It was a pretty rock solid move down through that 50-day, and I do think that we test that 100-day. Now, the positive thing that we have going for us here, if you're a bull, is that in previous accounts of Triple Q testing that 100-day SMA, it has held it. If you take a look, it held it all the way back right around 10.5, 10.7. It also held it all the way back in May of 2020, and it also briefly broke down through it, but ended up holding it when you go back to March of 2020. So in all of those, 2021, not 2020. So in all of those instances, we've held the 100. This time looks a bit different when you basically compare it to previous moments at which we have tested that 100 SMA, but that is something I will also be watching, the 100 SMA test on Triple Q. And then
it looks like futures just coming in starting red as well.
Are they? Yeah. So that's going to be something to pay attention to. Definitely. Now, if you're looking for a trade in this market, which most are, I find it that your best likelihood of finding a bull side trade is going to be within energy or financials. Also, what seems to be outperforming, at least today and the previous day, are basic materials specified in steel. So that may be an area to take a look at. Those areas of the market have been relatively strong compared to others. And I'd also like to know what we also saw today was names like Walmart, Procter and Gamble, those consumer defensive names outperforming as well. So what I am seeing is a lot of those boomer stocks, as people like to call them, are outperforming in the relative short term. So that seems to be viewed as a safe haven to this selling that we have been seeing. So I have been looking for relative strength within this market. I like to trade the bull side of things. I am not immune to taking a trade on the opposite side of the market. I just simply tend to be on the bull side, so that's what I'm looking for. And I am looking at those steel names, and I'm also looking at some oil names currently. So just a heads up, I'll probably post a few of those charts later tonight on my page as I go through charts brief over here the day. But I did see some relatively strong names today. Nucor was pretty darn strong. I really like the action out of Nucor today. I also liked the action out of United States Steel Corporation. But these could be relatively short-term trades. The market right now is very volatile. So you could see a short-term rotation into these names, but who really knows what we're going to get in the coming weeks? There's a lot of volatility, and you have to pay attention to that. And just an example of this volatility is really since the beginning of last month, we have been in this just choppy action. Since 11.5, this market, at least when you really look at it broadly, has been chopping. Triple Q hit 400 on 11, ended up at 400 on 11.5-ish that week, and it really chopped right around and bounced off that 400 level continually all the way up until now. And if you take a look at SPY, there really wasn't a huge amount of upside action throughout that time period as well. You take a look, it made that high of 479, but it really bounced around that zone or very close to that 470 level continually, and now we're back below that 470 on that same time frame. So those are a few things that I'm paying attention to. Very in and out of the market at the moment, not taking anything sizably long. I am still sitting on quite a bit of cash for longer term names, and once the market really starts to determine a direction, I'll start to get into that. But the previous speakers really nailed a lot of exactly what's going on within these markets right now, and really a lot of it is focused around what's going on with the Fed. So I continue to be focused on Fed actions, and that will be my focus going forward. And I think that will be indicative of the type of volatility and types of moves that we see in the coming weeks here. And I'd also like to know that if you're looking at a more longer term performance throughout the year, it is a midterm election year. And if you take a look at seasonality in midterm election years, it's just something to factor in to your analysis here, is that we tend not to perform the best in midterm election years throughout the majority of the first half of those years. So that's also something to pay attention to and that I have been monitoring. But that's just something I'm using in part when I do my analysis on the overall markets. But that's really my thoughts right now. Very in and out of the market. Taking smaller trades than I usually do, not going in with as much size, and being a bit more conservative. And I really believe that's how you want to be. You want to follow your plan, and you don't want to go in with gigantic size when you're in a market that is as volatile as it is right now and as choppy as it is right now. But that's really where I'm at. And yeah, I mean, I look forward to seeing what type of price action we see tomorrow.
Hey guys, I hope you don't mind me jumping in, but I got to run. I just want to thank you, Roll, and pound the table for me up. And always good to hear from you, Em. Glad to hear you, and Jay as well. So talk to you guys later.
Of course. Thanks for joining, Parrot. Hindsight, are you back yet?
Good to see you, Parrot. Take care.
Go ahead if you have anything to add there, MM.
Oh, well, one other thing I think is interesting to note, and this is just going back to the central bank discussion, because I think it's important for us to monitor not just what the Fed does, but really what all the central banks around the world are doing. And we had these initial indications from People's Bank of China that they were going to actually be going into a more dovish tilt, and they had been injecting liquidity into their markets. I think it was like 90 billion won one day, 90 billion won the other day, and then they started pulling even more liquidity out. I want to say starting Monday they pulled 200 out, and then yesterday they pulled another 200 billion out, and that's interesting because again, like, you know, first, China's real estate market is the biggest market in the world of any market, you know, whether it's a real estate market, equity bond market, whatever. But the other thing is that they have their own issues over there that are pretty significant and could be destabilizing to global markets. So to see them pulling back on liquidity, I found that pretty curious. One macro person I talked to said they might be concerned about the spread between the Chinese 10-year bond and the U.S. 10-year bond, and pulling that liquidity out gives it a chance to have yields rise. Of course, the 10-year is now in a race to go higher on our end too. So that if that's the motivation, that's interesting if they're trying to compete their debt out on the basis of what it's paying. Of course, I would consider Chinese sovereign debt to be a higher risk than U.S. government sovereign debt, but perhaps that's one of the reasons they want their rates to be higher. But you know, I think we need to look at kind of the global balance of liquidity. And the reason I say that is when PBOC pulled back, and that was in February and May of 2021, that kind of marked the top in a lot of speculative growth in Chinese tech, but also in a lot of U.S. small to mid-cap growth in tech, SPACs, biotechs, et cetera, because the velocity of central bank liquidity began to peak around the same time. So I think it's important to kind of watch what's the People's Bank of China doing, what's the ECB doing, what's the Bank of Japan doing, because they're also major providers of liquidity to the market, and their balance sheet growth or contraction has a pretty big impact on the potential for a price discovery and risk asset. So I just want to put that out there.
Awesome. I actually just shared a tweet. It's pinned above, which is our next spaces around cybersecurity, which is going to feature MM, Brad, Freeman, Francis, and Eugene. So pretty excited about that next week. So if you guys do want to save that in your calendars, it's pinned above January 12th, 5:30. And we also have Brian Feraldi tomorrow morning or tomorrow afternoon at 12 p.m. Eastern, morning for some, afternoon for others. But yeah, no, thanks for adding that, MM. KT, did you want to say something?
So there's an important thing that brought up, which is the liquidity from the Chinese market. That's where I'm like also looking at Baba and Baidu also for overnight calls. You know, like probably those are the ones that are not as affected by the chop that we are seeing in the market right now to play weeklies and bi-weekly options right now. So yeah.
So yeah, building off of that, I know there has been some regulatory crackdowns recently on Chinese acquisitions, specifically from Tencent Holdings. They actually have been selling off some positions in some quite large tech companies. I know SC was one of the victims of that. There was another company, I forget the name of it, but yeah, a lot of these big tech names over in China have posed quite volatile, but I want to see how the liquidity transformation, plays out over these next couple days, because from what the PBOC told us, from what their last inclination was, is that they would support their financial markets and, overall economy. But from what they've been doing this week, it's kind of been a 180-degree reversal. So that's definitely something that is going to be pretty important here moving forward.
100%. Did we lose MM? We probably lost him. Did anyone have a question? I don't know if we had any questions pending. If you did, please request. And again, give all the panelists a quick follow. These guys, share some great information. Luca, MM, KT, Jeremy Lin, pounding the table. Some of the earlier speakers, Special Situations, Jay. And we do these pretty often. So, if you follow us, you'll definitely be able to follow along with our spaces and our, general market observations. Looks like we have MM back. MM, did you want to respond to what Jeremy Lin was saying? I think he was commenting on the Chinese names that you just mentioned.
Oh, what was that? I'm sorry, I missed it.
Jalen.
Oh yeah, no, I just mentioned some of the regulatory crackdowns on Tencent, how they've been selling off some pretty large holdings, and then the other thing I mentioned was kind of just building off what you said, how the PBOC kind of did a 180 this week. So I want to see if that's like just maybe a short-term thing, or if that's going to be a continuation of their monetary policy rollout.
Yeah, I think those are both really important points. I mean, we were starting to get some maybe initial signs that maybe the situation in China was just beginning to show signs of green shoots. Maybe there was some opportunity over there, and then this happens. They kind of drop one shoe and then another shoe right on our heads. I think you're right. It's very important to watch whether there's continuity to this apparent 180, this sort of hawkish tilt that they made. I think it's also important to see whether that regulatory scrutiny continues. We still have a bit of a trade war going on too, and it's actually impacted one of their sort of dual companies, Huawei. Their revenues got hit. They're down like 30%, and some of that has to do with the fact that countries just simply aren't buying their telecom gear. So, China's kind of in a rock and a hard place. This is a country that typically, if inflation's too high, they have social unrest, and if employment is too low, they have social unrest, and they're starting to deal with both now. So this is a difficult situation for them to navigate, especially. So I'm very interested to see how they do it and whether or not they're able to come through it without more volatility, both in terms of their markets and in terms of the sort of socioeconomic outcomes and unrest that might come from it if this sort of stuff is protracted. I mean, the prices of food in China, we think it's gone higher here. It is alarmingly gone much higher there. So they're living in a different reality. I mean, I know we've seen prices of things go up here, but in other countries, it's a completely different world where prices are significantly higher. And there's energy constraints in China that have been a problem, and there are different variants of animal diseases that are hurting their livestock. And just Australia won't. Australia's basically stopped doing business with China. They really don't want to deal with them anymore because of all the sort of bullying that China did to them, and that's really hurt them because they're getting a lot of coal, iron ore, other things like that. So. I think it is an important economy to keep track of. It's the second biggest economy in the world. And just as an aside, I think it's kind of funny that people call it an emerging market. It's clearly emerged. I think we could call it a developed market now.
Yeah, no, totally agree with that. I think we have some more questions coming in. Thanos, I think you were asking earlier, but you might have dropped off. Ahmed, if you want to ask, whoever wants to go first, one of you two. Thanos, you there?
Yeah, I'm here. Thanks. I have a general question on the sentiment in the market. So, we are seeing a lot of bearish takes. So, how long does it usually last? If the QE or the QT is happening, and then the rate hikes are going to happen. So, are we going to be in a bear market for H1, H2, the entire year? Like, what does the history say here? Any input on that?
Yeah, history typically says that it really has a lot to do with the abundance of liquidity and the policymakers that are in charge of making that liquidity available, right? So the real pivot. I mean, look, we have historical examples, right? So one of them is what happened in 2018, and we saw quantitative tightening, and that quantitative tightening and those rate hikes led to a pretty significant rout in the market, and the only time that we saw the market make new all-time highs again was in the summer of 2019, where all that policy was reversed. And then you see, what we had leading up into the Corona correction, and that was, both an increasingly fragile market at that point. In the back half of 2019, even though the Fed had gotten a little bit easier, it clearly wasn't enough. Credit markets were showing their fragility. Repo markets were looking pretty bad. And so we were heading into something. We didn't know exactly what that was going to look like. I thought it would be a little bit less severe, but then we had COVID as a economic catalyst, as a macro event catalyst, and that wall of liquidity from central banks is what really brought the bid back to equities. So the point is that really central banks would need to make a U-turn. They would need to get back into an accommodative posture. If indeed they are engaging in QT, if indeed they are draining the pool of liquidity that bids risk assets higher, then the only thing that really ends that route is liquidity returning to the market in the form of central banks reopening the spigot. Markets are addicted to liquidity, and valuations are still, even after some of the corrective activity we've had, well above historic norms, especially in some parts of the market, like in growth and technology. Even though I love a lot of these companies and the innovation that they're able to bring about, realistically speaking, a lot of these valuations are not sensible in an environment of constrained liquidity and rising rates. So that needs to change if price discovery is going to become more positive again, in my opinion.
Does that help answer your question, Thomas?
Yeah, it did. Thank you.
You're welcome. Ahmed Al-Sfawi.
Yeah, hello guys. Thanks for doing this. I have a question about the growth stocks. Because I think the Fed can increase the rates till 2.5%, but if we can go back a couple of years ago, like the growth stocks still performed well. So I don't know, like why should we be kind of anxious about investing in the growth stocks at the moment?
I think when you look at growth stocks, it's important to realize that they are high beta, long duration risk. And when real rates begin to rise on U.S. sovereign debt and other instruments that have yield, you have competition. You have basically, you go from return free risk, right, where it is right now, where you're getting a negative yield, so it's not keeping up with the rate inflation. You're basically paying the government to own their debt. If that paradigm shifts, then people's risk appetites shift as well. And that's where you see discounting of the premium that's built into this risk. So I think it's important to kind of look at growth stocks for what they are. They are on the higher end of the speculative curve. A lot of these companies don't make bottom line revenue, and so there's a longer duration until when you might be able to expect a bottom line profit, and thus they're competing with things like the 30-year bond. Now, if the 30-year bond or the 10-year bond begins to go into real rate positive territory, now you have other assets that people can buy that create a guaranteed return with minimal risk, and so there's more competition. That's one part of it. The other part of it is, some of these companies have funding costs that are going to rise. If you have rates rising, the fungibility of their debt diminishes, and if these companies aren't producing profits that are requisite to offset their debt, they either dilute shareholders or they accept debt at a higher rate. Either one is going to serve as a multiple compressor. So I think those are things that we need to keep in mind. Growth is kind of at the whim it's kind of at the whim of the abundance of liquidity that exists in the world. And we can see this correlation. You can see a correlation also if you look at the price of the 30-year bond and the price of the NASDAQ, or the price of the ARK ETF, or the price of your favorite growth stock. There's a pretty solid positive correlation, especially over the last 8 to 10 months. And that has a lot to do with the correlation between all of these various assets and the abundance of liquidity. So I think the reason, and it's not just, anyone on this the spaces that are a little bit perhaps justifiably concerned about growth. Look at the market. I mean, they're just liquidating this stuff. And there's a reason that institutions are liquidating this stuff. And remember, this is the beginning of the month, it's the beginning of the quarter, and it's the beginning of the year. So these are institutional flows. They are deciding how they're going to position themselves and their clients, and they are just selling the stuff. And they are moving into more defensive plays, and they're moving into more cyclical plays. They're probably raising some cash too.
Okay, sweet. Thank you, man.
You're welcome.
You got it.
Ukwa, did you have a question?
Yeah, thanks guys for putting this together. My question is about how we're looking or thinking through what risk is, right? Because in my mind, it's the permanent loss of capital. And yes, you can make the argument about liquidity right now and the impact it's having on the market. But how are you guys thinking about the permanent loss of capital, especially within the growth names? Because yes, it's going to impact them in the short term, but if we're looking 3 years from now, looking back, we would still be able to look back and say that there were some huge gains that we could have had if we had picked the right growth names at this time. So are you thinking through it as the situation where you're timing the market now and saying, well, in the short term, I'm not going to be able to make any money from these growth names and maybe we rotate back? Or all the growth names that we're talking about now are horrible and we shouldn't be investing in them? How are you guys balancing that with regards to the fact that you would have some names right now that people might think are defensive, but 3-5 years from now, they don't actually make any sense?
So I think with growth and really with investments in general, a lot of it depends on your time horizon. If you look at a 5 to 10 year time horizon, this is a bump on the road. This is probably noise. Does that mean that you might be able to get things cheaper in the future? yeah, you might be able to get things cheaper in the future. But if your risk tolerance is, is healthy, and you have a long time horizon on these things, and you're not like most folks who are looking for a return in 3 to 6 months or less, then you're probably okay as long as you can sleep at night with the amount of risk that you have on board. On the other hand, for some folks, they're really looking for very immediate returns. There's a lot of impatience. We see the fastest turnover in stocks in this market that we've really ever seen. The average holding time for stock is like a month now. So you got to also ask yourself, what are other investors doing? But it really is all about your age, your time horizon, your risk appetite, and whether you're comfortable with what you hold, and whether you can reevaluate your investment thesis and believe it's intact, for the time horizon that you plan to hold those investments. If all those boxes can be checked, then your plan's intact, right? But if you start looking at that list and you say, I'm not so sure, then maybe you need to do some rebalancing.
Yeah, that's a great point, I know I've been on the spaces and just, have been talking about my time horizon's really not, kind of 3 years. This money's mostly for kind of a house at some point. So I think like how I'm looking at it is like these growth tech stocks, right? Like, whatever name we're going to talk about, I don't think you're going to miss it if like I'm not saying you'll time it perfectly, but these things will base and normalize and kind of give you a range of where they'll trade at. So I think you can, I don't want to say time the market, but you can kind of start figuring out where the price floor is. And, again, like Mayhem said, it is your kind of time horizon. If, you are looking out 20 years, I think any of these names that, are some of the FinTwit darlings, I think it's perfectly fine to kind of dip your toes in right now. But, but I think calling bottoms right now and trying to dollar cost average your way to getting this as fast as possible is emotional. It's probably not the best thing to do. I think you can really just sit on your hands and wait. Or, this is a good time to also look in the mirror and say, okay, am I comfortable in everything I'm in? Do I have too much risk on the table? Do I need to raise cash? Where do my cash positions need to be? But again, that's a very personal, when you're running your own accounts, that's very personal. No one on this space can tell you what your comfortability should be. That's kind of up to you. But those are just my thoughts. I think you'll get you'll start seeing a base around some of these things, and that's when you can start thinking, okay, your toes in, start with, however big of share lots you do. Like, you could even start with 5 shares, with some of these discount brokerages. I remember, well, I don't remember, but back in the day, you had to start with like a sizable position to even get the stock you want. You can dip your toes with a share, 2 shares. So, but I would not be aggressive right now, but that's just me.
I agree with what both these guys said. I think the biggest 2 things that I'm looking forward to is the continuation of what the Fed says. So kind of what pointed out leading up to options expiration later this month, as well as earnings this quarter, because not only do you get earnings, but you get year-long guidance. And I think it's important to see the follow-through on some of the companies you own and making sure that they're executing and actually doing well. Because I think not only are we going to be in a very difficult market, but only the best of the best are going to be rewarded, where I think getting removed from this the market that we saw the past 18 months, where anything with a small catalyst was getting a big bump immediately, right? I think those type of moves are going to be less and less frequent, and it's going to be given to the companies that are, I guess, doing the best. And I think the range point that Eric mentioned is a great point, because Tesla traded range bound from 2014 to 2019, right? You can say the same about Apple, almost 2015 to 2018. So these stocks have these ranges for quite some time. So I do like that point, Eric.
You'll see it. And something else to consider, which I know we're trying to be more long-term investors, but when you'll start seeing the cream of the crop rise to the top, right? So I'm just throwing a stock out here. I'm something I've just noticed. Pure Storage isn't that far off its highs. Well, why isn't it that far off its highs? It's because someone is continuing to kind of look at that and say, wow, that's interesting. That's something I want to be in. So that's a good screen to do. Kind of look at what's kind of staying above its, within its 52-week high range, and do some homework. I mean, It's tough though. I mean, trust me. I got shaken out of everything, so it is not easy right now to say, to be in this or to be in that, or where should I go. Um, even ETF. I know we haven't covered this, but I just got some stuff about covered call ETFs. I'm even thinking, maybe I just park 20% of my account in some covered call ETFs, collect some rent, see how the quarter goes. Maybe, I see a Datadog continues to accelerate. I go in there. You just got to, wiggle your way through at this period. And if you don't know what to do, though, again, part of it is stay in cash. It's okay to be in cash. If you don't have an edge, that's your edge, is waiting to figure out where to go next. Anyways, I can talk a lot. So that's those are my 2 cents.
No, agreed. And I think the biggest thing is you can't borrow conviction, right? So you have to research and kind of know what you want to own and why you want to own it. I mean, if you can't say the why you own it or explain it to a 5-year-old on the business, then it's your money. I mean, I have a tweet pinned up here before buying all the things I'm looking at. So that's just some of the things. It's not even everything, right? But you have things like, what is the company trying to sell? What are the margins? How's the free cash flow? How's the company allocating its own capital, right? So it's the ROIC, return on its invested capital, which if you saw Zuck and Bezos, people just look at their products and think, oh, they did a great job. But these people, these CEOs invested money so wisely that it generated these massive returns into other streams of revenue and products and services, because you not only do you want your company to make revenue, but you want to see how that company is using that revenue and how are they reallocating, and that's how mega companies are born, right? So what's the competitive moat? How's the execution and history of the company? What's the product market fit, right? So all these things like future growth, like there's so many things that you can look into for a company that I think I don't know if people are spending enough time doing. So this is a great question, and I think we can talk about this, as Eric said, for quite some time. But I think we have a bunch of questions. I see we have Caleb on. Caleb, what's going on, bro? I don't think I've ever heard you live.
Oh, hell yeah. What's up, Caleb?
Yo, Caleb, you there?
Yeah, I'm here. I think he's here.
Hey, Caleb, how's it going?
Rahul? Anyone?
Yeah, we hear you, buddy.
We hear you. What's going on, man?
Oh, I don't know what's going on.
No, we hear you.
Yeah, we hear you.
Twitter Spaces is glitching. Say it isn't so.
It's not this time. It's Caleb. I bet he's on
Now you had to jinx me, didn't you, Rahul?
No, Thanks, You know what the funniest thing is? Listen to the story, you guys. Everyone wants some humor. So, is a machine. Everyone knows this. I get pings all the time. Oh my god, like this guy's amazing. And I just texted some guys on the side. I'm like, we have Mark and Mayhem on. I convinced him to come on. I know he wanted to take a hiatus. And guess who texted me? Because before you came, Special Situations was on here, Jay Singh. And he was flowing just like you do, macro, like crushing it. He got kicked out at least 5 times, but luckily he was able to get back on and finish his sentence every time. And then at the end of it, he's like, "All right, I'm tired." He gave his 5-minute spiel. And he texted me immediately after. He's like, "Is this an Android issue?" I'm like, "I think so, because it happens to Avi and you guys are both Android." And he ran to the Verizon store. He's buying an iPhone right now.
Yeah.
He's so tired of this issue.
Yeah, he texted me and asked me if I was having the same issues and if I had an Android phone, and told me he was getting an iPhone mini. So I hope it works out for him.
Yeah. I mean, I'm going to have to ship. If you guys want to crowdfund an iPhone and send it to him, we can have it on every single space, because he's down to come on. It's just the technical issue that's holding us back. Caleb, are you Android?
Hey, Rahul. Yes, I have Android. Can you hear me?
Oh, now we can. What's going on, man?
Hey, Caleb.
Hey, how y'all doing?
Man, how's it going, dude? You share some amazing just journaling and tips through your couple of years. Do you want to share anything with the audience? I mean, I'd love to hear from you.
Yeah, I just want
to... Caleb, before you wrap, Caleb is maybe the best long-term investor on this platform. So, he does it right. Him and Chris Peruna, I mean, they are just... You want, real good long-term investors, those are the two to really, follow, because they don't... Again, everyone gets so caught up in, the day-to-day, and I just feel like those two are, the best of zooming out. So, wanted to plug Caleb real quick, so...
I appreciate that. So I just wanted to really quick touch on a couple of things that I heard in here, and I think right now, and up to now, the most important thing to know is your own time frame. And my first couple of years, that's what really got me all chopped up, where, I joined, I was on my own, then I joined FinTwit, and I was hopping around in all these different names, and My second year, I bet you I was in 100, 150 different positions, just ridiculous. And that made the tax return really fun. But I think that if you don't know what you're trying to achieve, you're going to be in and out of names. You're going to be tracking tons of different companies. You're going to be trying to do due diligence and research, and it becomes very difficult. And on top of that, what I'm having personal problems with right now is comparing myself to other people who are always miraculously timing the markets perfectly. And, in hindsight, I can see how I'm missing these things, but I'm not concerned about what other people's results are. I don't care what other people are investing in. I'm concerned about figuring out how people are finding what they're doing so that I can replicate that on my own. And I find that the best results to be through proven winners that have wrote books and have a track record. The next thing I've found that has been very helpful is predetermine my buys on a timeline. If I want to say I want to invest in, I don't know, Lululemon, for example, determine how much money I want to put into it. If I want to put 10 grand into it, 50 grand, whatever, think ahead when I want to buy that. Once every 3 months, once a month, once every 6 months, whatever, so that way you have a logical process of when you want to buy. And for long-term investors, that's what it should be, right? Over the time period, your cost is going to average out. And over the long haul, hopefully it's a great company that's going to go up. Because the problem I've had all of 2021, I was buying all over the place. And after today, I am really wrecked in a lot of different positions. And had I just either went a little more in the beginning or held off maybe after different earnings, things like that, instead of just trying to, follow different people's processes. Oh, I'm going to buy when the 5 is above the 8. I'm going to buy the 50 day. I'm going to buy the 200. You get really confused on what you're trying to achieve. And I think that by having some sort of a ebbs and flow, some sort of buying system for yourself, and that's going to change over time. Your process is hopefully going to get better, but when you're trying to execute based on someone else's timeline and what they're doing, you're always going to be behind, and that's going to really chop you up. And I just started my 4th year. I try to be about as transparent as I can. Eric had compared me to Chris Pruna. I'm a rookie. He's been doing this for, I think, about 20 years. Most of it he's posted online. It's truly incredible. He's got a thick backbone, and he knows what he's doing. And, he also follows CanSlim by, William O'Neill. So, that's a whole other ballpark of where I'm at. I'm still trying to figure out, fundamentals, valuations, and my own process. And one other thing that I just wanted to really quick touch on was on Fintuit, for example, because a lot of us spend a lot of time on there. When you start seeing names popping up left and right all the time, everyone's hammering the same names, check the charts. If you don't know how to read a chart, either reach out to someone who does or just, Google and look up basics of charts, because if things are, flying high really quickly, be leery of that. And what I need to do is step back and say, there's going to be another great entry. There always will be. But what happens is you buy that thing up. I think Pruna was saying that, if the stock's 70% above the 200-day moving average, be leery. I'm in a couple of really bad positions right now because I just don't want to sell them. Well, I should have been paying attention to how popular something was. And then Eric just touched on Pure Storage, ticker PSTG, I think. That's a name that hasn't been on Fintuit a whole lot. I believe they reaccelerated after their last earnings, and basically the executives did exactly what they had planned out. Those are the types of names that when you hear, start doing some research on them. You want to get in names early before others. I had the fortune of getting into a few early in 2019 and 2020. So some positions I'm in a good spot right now, selling off, but some I'm not. So it's all about building your own process, and that starts with numero uno, understanding your own time frame, and do not play other people's games. That's kind of what I had to share.
I couldn't agree more, Caleb, and I second what Eric said, man. His genuineness and honesty is always amazing. So thanks for sharing that, Caleb. I actually just shared one of my threads that I had written around this question and this concept of things that you look at before investing and themes, and it highlights your due diligence and conviction process and moving averages, institutional ownership, and so on and so forth. It's a pretty long thread, macroeconomics. So it's pinned above if anyone wants to kind of get into that. I think it really elaborates on a lot of the points we've talked about in this space, and I think it'd be pretty helpful just for the audience, because I think this is the time that a lot of us need to kind of make sure we're listening and following the right people. And not saying I'm the right person or anyone here is the perfect person to follow. But what I'm saying is it's important to make sure you have the right information at your toolkit and you're just looking at the right things and making sure you're not making fearful or decisions based on emotion. So definitely something I wanted to share. And thanks for joining, Caleb. Always good chatting with you, and thanks for coming on. Param, did you have a question?
Hey guys, thanks for hosting these spaces. I do have a question, not about the market, but about pounding the table. It's been a while since we had the last podcast. I think it was in November. You guys are actively doing spaces. Have you considered recording some of these and uploading them as podcasts?
So these spaces, actually, we uploaded them onto YouTube. I'd say not too long ago. Let me find the tweet and pin it. We actually loaded like 8 or 9 spaces, and they're on our YouTube channel, so you can see all of our spaces from I think end of November into December. So we have that. We've already run, I think, 3 or 4 spaces. Sorry, this week. So definitely. Hold on, I pinned this above. So this is a thread of all the spaces from November 20th, I believe it was, up till now. And from this week, so this week's space, so we had one on Sunday with we had one on Monday, I believe. What's the date? I don't even know what the date is. Today's Wednesday, so we had one today and we have one tomorrow with Brian Feraldi. So shout out to Luca. Actually, he helps load a lot of these this content up. It's just challenging because you have the actual podcast. Luca has his own podcast. Then all these recordings have to get rendered from Twitter and converted into a specific format, and it's uploaded on YouTube. So we are loading all this onto YouTube, so that's definitely there. In terms of the actual Pounding the Table podcast, I believe Avi and Tony. Tony was in Colorado for some time. Avi had a big job switch. He's moved into a crypto company. He left Martech sales that he was in for quite some time in November. So both of them were, I guess, a little bit off schedule. So I think Avi tweeted yesterday that he's planning to record this weekend, and the podcast will be back. But in the meantime, I think in a month and a half or 2 months, we've ran 15, 20 spaces. So there's been plenty of content, and it's all there. It's on YouTube, I believe. I think we've hit most of them, or at least the most meaningful spaces. Some of them are just kind of fun, casual conversations. But anything with significant context, we had the pre-Fed coverage last month, the FOMC meeting coming December 15th. We had a space that day. We've had so many Sunday special spaces leading up into the week. We ran them every Sunday in December, and we ran it this Sunday as well, leading up to this week. So all that is there, and we'll continue to load that information and share that. And the actual podcast should be back to crossing fingers. I think they're going to record this weekend.
That's good to know. Thank you. Yeah, I'll check out the YouTube channel also. Thanks.
You're welcome. And it's pinned above. It's a Happy New Year thread. Has all the YouTube links for each date, who the speakers were. So you can just kind of follow it there if you'd like. And as for our next space, like I said, tomorrow is Brian Feraldi, and I've also pinned our cybersecurity space, which will be next week, January 12th. And hopefully, MM's phone cooperates and we can keep him on like we've kept him on today. So, KT, are you still here? We haven't heard from you in a while. All right, guess not. Anyone else? Any questions? Any closing thoughts? We've been running this for 2+ hours. If there's no question, I'm happy to end here. But or anything you guys are looking at for tomorrow?
Yeah, I think it's important to kind of see what we do to close the week. The first week of the month of the first month of the year is pretty important. In some years, it kind of sets the some of the formative trends for that year. So, some of the things that we're seeing this week, outside of today perhaps is, and even in today, if you really look at what was the least weak, I mean, energy, materials, industrials, some of these late cycle names have really been the beneficiaries of market flow. And then we've seen, a pretty good amount of distribution in the more rate sensitive, longer duration, high beta stocks, the growth stocks. And, and I think, crypto's been under the gun a little bit as well. So really, the stuff that is on the higher end of the speculative curve is getting more distribution. The stuff that is making money in the here and now and seems safer and is more conservatively valued is getting a bid. I mean, the growth factor's out of favor, the value factor's in favor. And so we're trying to see, is there going to be continuity to that? Is that the shape that this year is taking. And it's something I've talked about a little bit on previous podcasts and on spaces with you guys. We really want to pay attention to this stuff. We want to pay attention to the Fed, to the macro, to the technicals. We are seeing some breakouts happening in energy and certain parts of the financials. In fact, when you look at some of the areas that were performing even today, that were performing to the upside, not just the least weakest, it was a lot of financials underneath the surface, asset managers, things like that. So there's always parts of the market to sort of hide in when the going gets tough if you're a trader. I like to look at where the flows are going short term to know where I might be putting on positions. I also like to look at where the flows are going out of to try to understand where institutions are kind of shying away, whether I'm going to be, trying to stay away from those sectors or potentially even short those sectors, depending on what it is and what the risk reward ratio is. So I think going into tomorrow, going into Friday, we're going to be looking at markets and try to see, is there going to be continuation? Is the selling over? Is the selling going to actually roll over? And we're going to break out or break under these support levels that we're at to new lows. Like today, Nasdaq's closed at a support trend line that it's held for quite a while. I think this trend line, I'm just pulling up the chart right now. It goes back to October, but it really goes back to May. And then you look at the S&P, it actually did close below the 20-day moving average. Does that mean we're going to get a 50-day moving average touchdown, the tests like we've had in some of these prior routes, or maybe even a touchdown on the trend line? Those are things that I'm really looking at and watching, because right now, we're in a market that there's not a lot of certainty. There's a lot more anxiety after today. You can see it with not only how the indices behave, but also how volatility behaved, also with the kinds of flows we saw at an institutional level in puts. And we don't have more than maybe 2.5 weeks before we get to options expiration, and the next Fed meeting, which are all in and of themselves volatility drivers, and you put them all together, it could be a little bit of choppy sailing. So I think in the week ahead, we kind of look at how we close Friday. I think it'll be a good time for us technicians to review the charts on a daily, weekly, monthly basis, kind of see where the patterns are, that there's opportunities. For investors, if you're in this for the long term, it's like Caleb, you've got to be disciplined. You've got to have a mindset that lets you focus on really managing risk first, so that reward can follow. And you don't want to follow on to some of the things that are like the trending stocks on FinTwit. I mean, it felt good in 2020, and a lot of people were handsomely rewarded for doing that. But, times change, and sometimes the things that are in favor tend to be the things that are also the most vulnerable. And so, one of the things that I recommend to everyone who's, looking at the stocks that have been the high flyers, why did they fly high and why did they get discounted so aggressively? Look at the options flows. Look at that on Ford yesterday, for example. It was acting like Tesla. There was a lot of call buying. They were hitting near the money strikes, near expiration, and that was causing market makers to be more inclined to hedge delta, which meant they bought shares. And the options buyers would kind of gradually walk up the strike ladder to keep those shares getting pushed higher. Well, that was the same thing we saw in some of the high flyers earlier this year, like Upstart, Asana, Affirm, and Tesla, of course. How could I forget Tesla? Was the options market. So, keep in mind why upward price discovery is happening. Something trending? Is it really popular? Is there a lot of unusual options activity? And if it is, what happens when any of those conditions change? What if it's no longer the darling? What if the options flow dries up? Is there just a pocket of hot air? Is there a poor technical structure with a lot of gaps? Is there anything that gives you a sense that maybe this isn't durable? And we saw the same thing like in Cloudflare as well, right? So even though it feels good when something's running higher and our investment thesis is being validated by price action in the market, I think it behooves us as investors or just speculators or just spectators, if we're just watching from a side, like, wow, why is that moving, to know why it's moving. Because if we're tempted to get in and we know that the price action is happening from factors that may not be durable, maybe it's not the best idea to get aggressively long, right? And on the other side of it, if you see something that's aggressively being bought, it's not options, it's actually institutions that are just consuming an inordinate amount of shares, and that's a really big vote of confidence, maybe that's another reason to say, hey, I'm going to take another look at this stock. You've seen some of that stuff in stocks like Micron lately, when they actually were able to beat earnings for the first time in a very long time. So, understanding why price is doing what it's doing, I think, is a really important tool to have in our toolkit. There's all kinds of ways to monitor options flow. A lot of them don't cost money if you have a decent broker. You can just look at the order book. You can look at different expirations. You can look at premium, implied volatility. And I think for everyone here, and I'm going to leave it here, I want to be mindful of everyone's time, but I think for everyone here, it behooves us to learn more about options. Why? Because in 2021, there were 50% more options traded than stock. That's never happened before. And the premium paid for options was like 10 or 20% higher than that for equities. And also another thing, leading into the route that we had November, December, we had the highest call premium paid ever for equities in the history of the stock market, and the highest amount of put premium sold ever in the history of the stock market. And those are two huge red flags. That's retail getting euphoric. That's what that was telling us. There's in no uncertain terms. That's exactly what that was telling us. And the message was like blaring out at 110 decibels. And it was kind of hard because in that moment, everything felt kind of good. Hey, we're coming off the lows. The market's rallying. You know, some of these stocks are coming back to levels that look pretty encouraging. The charts are looking good. But the why was so important, and it was not durable, it was not natural, and that's one of the reasons we have this kind of volatility getting so bad in the aftermath of that. So, you know, I'll leave it there. Just recommend learning more about options, learning more about flow, watching them in the stocks that you hold, the ones that you're looking to get into. I think it really helps us a lot. Options are driving this market. The tail is wagging the dog more than it ever did before.
Yep, impressive. Definitely very well said there, MM, and I'm glad you mentioned that. I think Rohan, I'll happily take your questions. I think you were booted off and had to come back on, and then maybe we'll end with Matt Fenema as the last question. But Rohan Su, did you have a question?
Yeah, hi guys. Thanks for doing this. Appreciate it. Hopefully, pretty simple and a good question. A couple of you alluded to, two kind of vital data points coming out later this month: the new inflation numbers from the Fed and the options expiry. I suppose I was just wondering, when do those things happen, and when would you expect that to kind of flow into the market?
I think the questions around the expiration, OPEX, and the next Fed meeting.
I'm sorry, could you repeat the question? It was breaking up just a little bit for me.
I think his question was, when do you think these things, I guess, expected to play out in the market? So you have like expiration coming up, you have those options buying that you talked about earlier into the Fed meeting. So I would guess a lot of this gets front run, but I don't know if you have any further information on that.
Sure. So let me go ahead and just pull up a calendar here first. I want to make sure that I get everything right for you guys. But basically, you like Rahul said, you do see more front running of this kind of stuff than you used to. I think in particular in the back half and really the final quarter of 2021, we started to see that. I mean, remember, and I got to give mad props to Jem Carson. I mean, the guy is not only a walking brain, but he has been giving us so much alpha for free for so long. You have to decipher some hieroglyphics, but once you get there, the guy is obviously on top of his game, and he was a market maker. He's been in the market for decades. He knows exactly what he's doing. But he was the one that really identified this whole phenomenon, this window of weakness, this options expiration-driven volatility, and kind of how those positions really drive a lot of the passive price action at the index level. So I just want to give a big heads up to him because I've learned an incredible amount. So options expiration, January, it's going to be the 21st. I believe, and I'm going to make sure I'm right, but I believe the volatility product expiration is going to be on the 19th. It's usually the third Wednesday of every month. So it looks like that's the case. And then I believe you got the Fed meeting on the 26th, right? So basically, the way that this tends to work is options expiration is kind of the beginning of that window of opportunity for bears. So you probably see some chance that maybe we'll front run that. It's a holiday shortened week, so maybe Tuesday, Wednesday, you start seeing some volatility potentially. And Wednesday is volatility product roll off. So typically after that, volatility does start to increase. You got a lot of people rolling their hedges, so that creates some different flows that can be a little bit bearish in the markets. Then you've got options expiration on Friday, where it's probably going to be a near record setting level of gamma that's rolling off. So that's also a driver of potential volatility in the markets. And then you've got the Fed on the 26th, where they're going to be announcing any policy changes, and then Powell's going to talk in the presser, and the policy statement, bad cop, Powell, good cop, that's been kind of the dichotomy. We'll see if that continues. But I think all three of those events are volatility drivers. So, long story short, the back half of January could be more volatile, really all the way through the beginning of February. And I think that's something that's important to keep in mind. Now, seasonality, typically you get like these strong flows in January. You have all the beginning of year, beginning of quarter, beginning of month allocations by institutions because they have to put money in the market. And we've seen a little bit of that, mostly in the cyclicals. But this hasn't been a strong start to the year. So we really need to see how tomorrow and Thursday go. Because if we get weaker into that window of opportunity for bears to take advantage of downward price discovery, it could be a little bit more tumultuous in the markets. Like if you go into that window of weakness, say below the 20-day moving average or below the 50-day moving average on the S&P, that sets up for more potential for a more significant drawdown. So it really also depends on how are we looking technically going into that window of opportunity for bears. Are we a little bit on the vulnerable side? They're probably going to be taking more advantage of that, because on the other side of it, you don't have that passive bid from hedges being taken off to kind of keep the indexes a little bit more buoyed. Like today probably would have been worse if it happened in the latter part of January. Like if the Fed came out in the 26th meeting instead of today and said we're going to do QT, that could have set off a much more violent reaction than we saw today, just as an example. So, I know that's not a super clear answer because there's a lot of different variables in the mix, but in essence, the back half of January is more likely to be more volatile than what we've seen so far.
Thank you. That's great.
I don't know what just happened, Emin. I think we went from like 300 people listening to 375. I don't know if people have more questions or something, but I thought we were going to wrap soon. But hopefully that answers your question, Rohan. Mott, Fenema, and again, I guess since we just had an influx of a lot of listeners, if you have a question, just request now. I hate to shut early because, especially on days like today, so I'm happy to continue. I don't know if MM has time, but I'll be here on the last one. Mott, did you have a question?
Actually, no question for now. Thank you.
Okay, all right. Tim, what's your name? The Stocksman. I think you just requested to speak. Did you have a question?
I think I cut out. I think when you brought me up, so I didn't hear what you just said. But
no, I was just gonna ask. Did you have a question?
Oh, I was gonna say two things. One, I was gonna say why you guys got that big influx was one because another pretty big space just dropped basically. So it was like mid conversation dropped, and then I joined here, and so I think everyone that was in that came, like a bunch of people joined from there and came here. Secondly, just a comment. Kind of, I mean, you could bounce off of that too. I would argue that just something in general, a lot of people are scared today because a lot of tech names and mid caps and some of the favorites of the year are down. Obviously, the treasury yields going up and rate hikes and stuff. It's normal kind of in the market. If it's expected, everything was laid out for you if you're watching the macro side. But what I wanted to bounce off of you and just other people in here would be, I do still think there are trades though. I think a lot of people are overlooking maybe the not so, I'll use the key term, sexy trades, like things like uranium, things like silver, things like materials still, metals, materials, mining, things like this are like still very attractive trades and trading at really decent valuations if you price to sales or price to earnings, whatever one you like more. Overall, I just think a lot of people are just, it's a lot of the retail, quote unquote, and also the COVID traders that are kind of shook, that were perma bulls, that are not seeing the opportunities in the market, but there still are quite a few sectors that are undervalued still, and it's not just. It may look from the outside that everything's plummeting, but it's really just tech and companies that are actually overvalued and shouldn't be trading this high.
Yeah, I think I'd pretty much agree with you. I think we've been on space. I don't know if I think you just joined, but yeah, we've been on for like a few hours now, and I think a lot of what you said is pretty much what we've been echoing as well. That there definitely are trades, just sector-wise, you have to be smart. And
what sectors do you like? How about that? I asked that question so people listening, or maybe the new people, maybe you've said it before, but sure. Just so I can help out them, you can help out all of us. I'm saying help out everyone.
Yeah, no, of course. Yeah, I mean, I think the most obvious sectors you have is financials, right? So with the rate hikes, and I think you're already kind of seeing that a little bit. I think there are still some growth stocks that could do well depending on their Q1 earnings and guidance. I think the key thing here is free cash flow positive and reporting positive revenue. Some of these that are still negative in terms of EPS, for example, like Affirm or some other growth stock names that have run up a lot. I think you're going to see a big divergence after Q1, which you're already seeing now, but I think that's going to continue happening. So I mean, I personally am in growth stocks most of the time, but I think like you said, reassessing your portfolio based on the different things you're seeing, whether that be rising yields, the different supply chain pressures we're having, inflation, as well as if rates and this liquidity changes that we see from the Fed, it's going to directly impact financials and also energy to a certain degree. What has held up pretty well, I think, until today was semiconductors as well. I don't know, what do you guys think about that? I think I'm just kind of reverting that as a question as well. I don't know if MM or Luca, what have you guys seen there?
I agree with your take regarding kind of where things could go for the factor. I mean, I think the more established companies that have free cash flow, and in particular also have clean balance sheets, they really need to have de minimis debt so that rising rates aren't going to impinge fungibility or cause higher overhead. But I think we're going to see a lot of sort of sorting through the chaff, and what's what's good will probably stay flat or rise, and what's not viable in a different macro backdrop where the time horizons from which investors expect cash flow to be produced, if it isn't already, and for it to be growing, those are going to be significantly compressed. I mean, the higher that rates go, and especially as real rates become positive, the preferences that people have to take on longer duration risk change completely. So I think that's, it's going to be sort of sorting trash from treasure. And quite honestly, like if we reflect back on 2021, like fully objectively, just remove all of our biases, remove any kind of ego from the whole equation. Let's be real, that started in 2021, right? It really did, especially in the back half. And so I think it's a continuation of that theme.
Can I also add to that? I want to add one thing about Intel specifically. It's one of the biggest laggers of the year, and it's in the Dow as well. That's one benefit of it. It's just the index trading and how it's going to get pulled up by a lot of the other Dow trades. Whereas Nvidia, AMD are not in Dow, so they're in QQ and things like that. So while they're getting pulled back, while I think Intel is going to suffer because of the sector direction, right? The trend of the sector. I think Intel is actually one of the low-key gold mines amongst the semiconductor plays that if you've been watching, if you've been keeping track of the whole sector, they are making big strides amongst the bigger names that are kind of popular now. They've been making some big strides, and again, their valuation is fair in comparison by actual multiples exponentially better than things like Nvidia or AMD. So
yeah, someone actually mentioned Intel like an hour ago. Was that you, MM? Luca, do you remember someone mentioned Intel?
Yeah, so someone did mention, and it has been actually relatively strong compared to the rest here in the past few weeks, actually. So,
yeah, I mean, in my opinion, I think Intel is one of those. It's a gold mine that the boomer trades are back online. We've seen beating the market up 2% today. Verizon up like 1.6, I think it was something around 1 point something. So get back to your boomer trades. Get back to the golden children and kind of the market where people like to settle. The yield is actually pretty good for Intel too. So wherever boomer money is going, if you don't know what boomer means, it means like old school, not the Palantirs, the Teslas of the world, but more like the the Pfizers, the Intels, the older names in the stock market, the Fords.
Even you saw Ford yesterday. I was just gonna say, yeah.
Yeah, literally the Fords, these kind of things. This is where you should be looking at for strength. And I think that's where you'll find the counter trend of the entire kind of quote unquote downtrend crash, whatever weird kind of narrative is happening right now. That's the counter trend. It's the boomer stocks, it's the Dow, it's the conservative names basically.
Yeah, the ones with less, I guess, multiple expansion and have been producing revenue for a longer duration of time. I get what you're saying. Totally fair. I don't know if MM is still here. I'm happy to take a few more questions. Oh, you are? Okay. Are you guys down to take a few more questions? I hate just closing a space.
Yeah.
We're getting an influx of questions.
No, if people are here, and I mean, look, markets are choppy and stuff's a little crazy. Let's help people out. I'm happy to hear people and do what we can.
Feel free to stay up if you'd like. Thanks for joining.
No problem, bro. I appreciate you for letting me up.
Of course. Thanks for this is what we're here for. Just getting better with each other. None of us are perfect at this by any means. Star, did you have a question? Did I add her? Thought I added her. Jeez. Hold on. I might have lost her. Satwinder, did you have a question? Eric Cox, did you have a question? Just feel free to speak, one of you. Satwinder, are you there?
Yeah, I'm here.
What's going on, man? Do you have a question?
My question is in these choppy types of environments, right? I know the Friday report is going to be huge, and I think next week is inflation, right? So in general, with tech, GARP names value growth at a reasonable price name. Do you use 200-day trading as kind of support, or do you foresee these type of names bashing through the 200-day and just sitting in tight for the next 1 or 2 months in cash? I know that's kind of a loaded question, but
yeah, no, it's we've pretty much got this question every few people. So I actually have a thread up. It literally says lately on Spaces, the general theme of questions I get is what do I look at, etc., etc. So that will highlight in depth the answer I'm going to give you right now. But to give you a short answer, 200-day, yes and no. I prefer looking at VWAPs, so that's weighted volume average of the price. You can anchor a VWAP based on a different date or a specific event if you had in mind. So, for example, you could have done it last year based off the March lows and anchored it there. So, for example, today SCC Limited lost its VWAP from the COVID lows in March 2020. That's definitely not good. And I think a lot of the 200 days you're talking about, in general, a lot of these big, I guess, growth names that have run up the most have seen that like support being lost, like chopped up in the past, I'd say, month or two, and specifically in the past couple of days. So theoretically or traditionally, yes, that was a great metric I think to continue looking at. But I think right now with the selling you're seeing is it's a lot more driven off the different macroeconomic information we're receiving. So yes, those are certainly averages you should be looking at. Just in general, understanding the personality of your stock, I would say, like that's a I think way to put it. And understanding how it trades versus comparables, how the options flow come into that stock, how its averages are holding up compared to the rest of the market. But I think there's a lot more information flowing in now compared to what the most of the market's used to, right? I think we've touched on this. Like we've been relatively strong, a liquidity-driven market. Kind of pointed out earlier since '09. I mean, you've had hiccups along the way, whether that be 2013 or 2018, and obviously the COVID crash in 2020. But with liquidity, I guess policy changing, you certainly have a lot of I guess more macroeconomic factors you have to take into place more than usual that people are used to. So honestly, that's a good question, but I think there's a lot more to look at than just moving averages now. Again, anyone else want to chime in? You certainly can.
Is that VWAP?
VWAP. I explain it in the thread I have pinned above. You can literally, yeah, it explains it.
Is it like a common way of like kind of charting and like?
It's not common. I think a lot less people use it. At least from what I know, some smart traders do use it. It's a little bit. I don't want to call it advanced, but it's like an add-on to a 200-day almost.
Sounds good. Thank you.
You're welcome.
I'm gonna also chime in a little bit to say that typically you want to use technicals when the market's in a consistent pattern, when there's something not fundamentally changed. The news we got today with the rate hikes and also the yields rising, there's a macro environmental change. So technicals matter when you have consistency, right? So that's when you can base your, because nothing's really changing. It's just the movement of behaviors, of trader psychology, things like this. But now that you have a fundamental change, basically to the scape of the direction of the market, what the future is holding, now technicals matter less, and now fundamentals. Now you fall back to fundamentals, and that's why we're talking more about price to earnings and valuations and things like that. This is when this starts to matter a lot more, and you're seeing that reflected by the movement in the market and where the money flow is going, what kind of stocks the money is flowing to in the markets.
I would just say I do think technicals always matter, no matter what the market's doing. They just change in how you use them. And it also kind of depends on what your trading experience and style and time frame and chart and indicators that you're using. But I mean, technicals can help you in a bull move, in a consolidation, in a bear move. I do agree that fundamentals matter a lot more. Macro matters a lot more because really what the market's looking for, what everyone wants to see that's a participant is weak macro and the Fed pivot. And if you see that and you see the Fed actually turn around and say, hey, yeah, actually we're going to consider maybe not putting our foot so firmly on the brakes, then I think that you could see a face ripping rally. Like, remember, I'm sure everyone remembers Jackson Hole in August of 2021, where we went into that and we all expected it was going to be taper, and there's a bunch of doom and gloom ahead of it. Everyone was hedged out to their eyeballs. I mean, it was kind of silly, honestly. And we got Powell come out, and and remember, there was a big clue ahead of Jackson Hole. This was little finite details you pay attention to that proves valuable later. They held the whole thing virtually. So if you're going to say the economy is in good shape and everything's going back to normal, but we're doing Jackson Hole as a virtual event because COVID's so bad we can't do it in person, so the big tip-off for Jackson Hole that it might be something a little different in my mind was that they did the whole event virtually. And of course we had Powell come out and he flashed his dovish wings, and the Russell, which was so short you couldn't borrow shares on the ETF ahead of that, and ARK was pretty close too, they flew. I mean, the Russell was up like 3% that day. So, that's the kind of reaction that you could have if we go from one extreme to kind of resetting sentiment the other way, right? And I wouldn't say that we're at a fear extreme yet. We're away from a greed kind of mode. We're getting a little extreme on the greed side at the top level. If you look at the S&P kind of challenging all-time highs, you look at the S&P equal weight. Surprisingly, the S&P equal weight made a new all-time high yesterday. I don't know how many people watching the charts caught that one, but I thought that was really interesting because it showed the cyclical components of the S&P equal weight were offsetting the kind of mega caps and the concentration of like 25% of the S&P market capitalization in just 5 names. They were more than offset by the run up in financials and energy and some of the other cyclicals. So that was really interesting. But yeah, so we just really want to keep an eye on all these things. And the reason I mentioned that technicals don't matter is because when you have the greatest conviction about a trade or an investment, from my experience, is when you get a convergence across things like fundamentals, across order flow, across technicals, across macro. Like when you see all these things lined up and you can build a thesis for your trade or investment off of all those factors, not only is it easier to put that trade or investment on and keep it and keep riding it higher if it works in your favor, but you also know how to carefully check your thesis, because if any of those things start to say, flash a warning sign and say this is no longer true, the stock crossed below its 20-day or 50-day moving average, or they just put out earnings and they don't look so hot, or et cetera, et cetera. You have multiple points that you can check to validate as to whether you're right. So I would say, for all of us, it's good to have as many tools as we're comfortable using. Don't overcomplicate your process. Find a process that works for you. It's probably a different process than what works for me, or the process that works for Rahul or anyone else. We all have our own process, and there's nothing wrong with that as long as your process works for you. And the other thing about finance, it's kind of a beautiful thing, is you have to keep learning. You always have to keep learning. So if you enjoy, kind of getting into the nitty gritty and kind of upskilling your knowledge, this is the perfect place, because the most you'll ever accumulate is going to be a grain of sand on a near limitless beach. That's how much there is in the universe of finance. And it's kind of awesome in that way. It keeps you engaged. It keeps you learning. It keeps you getting better. And the better that you get, the more that you can try to produce alpha.
So I agree with a portion of what you said, but I'm going to disagree with the idea that there's a paralysis of buyers now. There's a paralysis of liquidity in the sense that, yes, there's money sitting on the sidelines, but no one wants to buy anything. Your money is going to be getting worth more, which is why Rahul said that this is the reason why banks are going to make more money, and financial companies like PayPal and things like that will be the first of the tech sectors to bounce. And then you're going to have, I like the optimism when you speak on the combination of technicals and conviction and trades. But your audience right now is a group of, not speaking on most of the speakers, but a lot of the audience that's here is a group of people who are retail traders that have seen the market really in the last 2 years. The narrative has been you buy the dip, you buy the dip, you buy the dip. So I think the conviction that a lot of people listening have is going to be one of buy the dip, versus the one that I feel like you, Rahul, me, I haven't heard the other big, I'm assuming pounding the table too, is where now we're going to be a little more conservative with our money, and buying the dip is not a strategy. It's probably going to start sliding out of favor, right?
Yeah.
So that's why when I say the 200-day is not so reliable, going directly back to the question, it's not so reliable because if you were to utilize that, for example, on a high conviction trade like Palantir, you would have lost money. Right? You would have lost money in the last couple weeks. If you did that with Clove, you would have lost money. If you did that with AMC, you would have lost money. If you did that with GME, you would have lost money, right? And these are the kind of plays.
Not even just those stocks, even like the good companies. I mean, they all broke their 200-day.
Oh, agreed. Oh no, fully agreed. Right? You have the Rokus, you have the Zooms, you have the DocuSigns,
Zoom, C Limited, Square. What else? Like
Alibaba.
But to be fair here, I wasn't saying anything about the 200-day moving average. So to be clear, I'm talking about technical analysis as a tool in one's toolbook is valid whether the market's going up, down, or sideways. The 200-day moving average, I don't personally put a lot of weight in. I prefer Ishimoku. I prefer stochastics. I prefer looking at volume by price. Order heat maps in real time. I don't really look at a 200-day moving average. Truth be told, I don't put a lot of weight in it. But I do think that technical analysis as a tool in the toolbox is incredibly important, especially in a market where 65% of the order flow is driven by algorithms, which use technical analysis to make order decisions. So it's important for us to look at these things because the market's moving by virtue of them. Like today, the way that the S&P moved down, I mean, it quite honestly was very clinical. It tested every single pivot on the way down. If you're a technical trader, the way it moved down was kind of a beautiful thing. Even though it was scary to be an investor, you did see this very methodical kind of, it wasn't panic selling. It was pretty methodical liquidation from institutions, and it just pinged each pivot on the way down. It pinged a lot of these volume shelves on the way down, and it just kept grinding lower and lower. And you're seeing a little bit of reversal off that key level tonight and after hours. So the technicals still matter, whether it's a 15-minute time frame, hour time frame, 4-hour, day, week, month, quarter, year. I still think it's important to look at the charts.
Hey, just want to hop in, guys. I agree with Mayhem. I value the 200-day a little bit more, but that's just me and the 50-day. But in terms of today's action, I came in late, but I'm sure you guys credited it to leverage being washed out in the speculative names. In terms of the Fed, them being hawkish, I sort of don't think they did anything out of the unusual. They're giving themselves room to back away next week. I think it's going to be very hard for them to move and do anything. And I wouldn't count these higher growth areas out yet. Look at the 10-year; it's at 1.7. There's resistance at 1.75. If it makes it over that hump, I'll be surprised. But you'll get a little bounce in some of those areas. And in terms of the roadmap for 2022, a lot of analysts looking at the second half of the year being the better part. We got a bumpy road in the first half, but I wouldn't abandon growth names. I think you got to have that barbell. Yes, you want to own lower PE stuff, but someone was talking about NVIDIA. NVIDIA is a great name. NVIDIA and Tesla, the two best charts last year. IBM, and yes, these lower PE names are valued right now. I think you just got to stay away from the super high growth names. And if you do, make sure they're profitable. Make sure they make money. That's all.
Can I ask a pretty basic question? But I just gotta say this has been phenomenal. All you guys are just have so much insight. I gotta say, and no disrespect to everyone else, but Market Mayhem, this guy's like tweeting 24/7. He's become my favorite follower because I've just learned. I still have so much to learn. As you'll see from my questions, I just learned so much more about macroeconomics and the way that order flows and just really just help me kind of learn so much. I'm one of the investors who kind of I was always a passive investor. I always like right, but then COVID hit, and that's kind of my interest in that interest in stocks, macroeconomics hasn't sort of ended. So pretty basic question, I guess. Probably a stupid one, but I guess when I break it down, right, if institutions are moving the market, people still have their money with these said institutions. They don't want to buy these growth stocks. They're selling them. That money is eventually going to where's that money going to go? I guess, right? Are people going to say, "Hey, give me my savings back"? Are they
the sidelines? Going to cash.
So doesn't that just keep everybody thinking, "Hey, you got to buy the deep and dip and just wait until they dump it in"? I feel like it's just not that obvious, right? Or else that money. I looked at what Mayhem just said, where I didn't see it on charts. I'm really trying to learn charts, but I had the sense man, big tech's getting killed, but as a whole, SPY doing okay, even though SPY was down. But the weighted one you mentioned, I could kind of get the feel of that. It was everything else is kind of doing all right, et cetera. So, why would the Feds jacking up? Doing more rate hikes than expected? Why would that cause a bear market? What's are people going to call it their 401k?
It's not just so we covered this question as well, I think, in MM's pod. So I think I would start with listening to the podcast from yesterday because MM broke this down for 25 minutes, but it's beyond the rising rates. It's understanding the liquidity that the Fed has put into the system. What's the number? Are we at $8 trillion in debt as a country we've taken on our balance sheet? So this is beyond just the Fed raising rates. This has become a massive liquidity-driven, potentially credit-breaking, or think of it as a circuit breaker in the credit markets, and the amount that's bid off the U.S. What were we saying, MM? You want to break that calculation down?
Yeah, so
$50 trillion off the U.S. dollar or something.
Yeah,
I can listen to it. I mean, I think the first thing I thought was wow, it would.
MM, you there?
Yeah, hear me?
Yes, partially. Go ahead.
Okay.
Damn it! I think we lost him. But Eric, did you?
Sorry, let me shut my mic so
get to? Am I here? Or am I not?
You are breaking up, MM. I think it might be Twitter again.
Well,
Mark, disconnect and then reconnect.
But okay, I guess I overall get it. Everybody's going to need to pay whatever debt they might have out because shit like that.
So it's not the debt to pay back. It's the cost of capital goes up and naturally affects any growth company. So I'm going to give a very simple example. Tesla doesn't really need to raise more capital. They're actually a pretty healthy company. But think of a company like Tesla in this environment. If they need to ramp up production, they need to raise money for that. The cost of that capital to raise that money is directly affected by the the bond yields that they're going to have on the 10-year, right? So that's affecting on a company level. But then you have the Fed balance sheet, so the bonds that they were buying. So we are in QE mode, right? Fed is not only saying that we're going to turn down QE, but they're also talking about QT, which is quantitative tightening. And I'm probably going to end up posting a recording of this space because we went through that pretty in depth as well. So that's a very hawkish thing to do because the liquidity that the Fed has injected into the markets is kind of what's the markets have leaned on for the past several years, right? This market's pretty fragile. Any conversation about change in liquidity or debt or the way we rate debt has really something the market's kind of relied upon for many years because it's kind of the Fed's been very accommodating, right? And any kind of taper tantrums you've seen, like look at 2018 December, the macro environment was very different back then because you had a lot more international risk as well as the Fed trying to raise rates that time as well, based on a different growth factors that they were seeing in the economy. So this is beyond just rates rising, is what I'm trying to say. There's a lot more at stake with just global credit, right? I think MM broke that down in his podcast yesterday. He might be here again, actually. Maybe we can get him to speak. Stocksman, did you have anything to add to that?
I just want to make it simple because again, I like to keep in mind the audience that I'm speaking to. So a lot of times people are
I know.
Not as familiar as
I
quantitative
agree with
easing,
you.
tightening, all these type of things. So I try to make it really simple by saying pretty much the cost of money is getting more expensive. That's just it. When you add interest, bond yields, and you make things more, you make literally the money more expensive, then the pricing on things is different, right? If that's why Bitcoin pricing is going to go down because inflation is going down. So money gets more expensive, getting capital is harder, and items become basically more. They start to reduce in price because money is now worth more, and money is more expensive to get. Simply put, as simple as possible.
So can I just say that stock prices in general would just go down? So a company that's completely healthy doesn't need debt. It's just the fact people just have less money to pay for it would be the reason for, like Visa. Let's just say Visa stock price to go down. That would be the sole reason. Is just there's less demand because there's less money out there, right? Because like I guess that is that one way to think of it. Just less money to be spending on equities.
Well, you have to also think of it this way, right? Where are you going to garner alpha? That we are retail traders, as Stocksman mentioned. Majority of us on here are retail traders. I'm guessing. I don't know if we have any fund managers or market makers, but I'm guessing a majority of us are retail traders. So another thing you have to look at, Eric, is it's not about just, for example, taking, like, this is something a Stocksman mentioned just I think a few minutes ago, is you're gonna have conservative players do better, right? So the example you gave, Visa, I think we talked about Ford earlier, is because of the way their balance sheets run is they've been stable for quite some time. They generate free cash flow positive, and their revenue has been stable for year over year, right? And these things trade at a very reasonable valuation, so they're considered value names. But you also have to think about from a risk perspective, will someone managing record liquidity or billions of dollars from a hedge fund or a market maker want to take a risk in equity assets, or would they rather go into the fixed income trading, which, by the way, if many people don't understand this, is it's a lot more volume is traded in fixed income than the equity markets, right? So you have to think about risk management in this as well, right? So when bond yields rise up, you can garner some more yield and alpha, which has been taken away from the taken away from fixed income and put into the capital markets by yields coming down. So that's why a lot of the yield and alpha generation came from U.S. equities. With rates changing, the theme of that changes, right? So is it really worth going into a company like you just said, Visa, right, versus or going to a more stable, guaranteed liquidity you can get or garner returns in fixed income, right? Because rates are changing there, right? So those are the factors, and you have to think about the amount of capital these people are managing. This is not retail money, right? So they're putting a lot of money at stake, and that's the reason. First thing you saw in November when the Fed started becoming hawkish or gave any hint of hawkish comments, you saw a rotation out of these risky assets, high duration, long duration assets with no free cash flow at the moment, directly go into FANG. That's why Apple, you saw influx of capital move into some safer names that are much longer and stable and running, and almost became bond proxies, right? So it's a direct reaction to the comments you're seeing. MM, are you back?
Shows he is, but
yeah, it's his phone always rugs him. But does that make sense a little bit, Eric? This is it's a very simple question, I know, but it's a very
No, it
deep
makes a lot of sense.
a concept to understand.
It answers a lot of sort of questions that I've sort of had. I mean, I need to read more about it, but it makes a lot more sense. I think I'll throw it as the final follow up. So, like, again, thinking of that money manager with all all that liquidity. What is it that a fixed? When I think of fixed income, I mean I could think bonds are like thrown in a savings account. So I would just sit here and be like, and this my plan this year is really heavy in Visa, MasterCard, and then banks because people were gonna. I would rather have my money in it. Me as a normal person would rather have a lot of money in a savings account where I could guarantee 1 to 2% or 3% versus the 0.5% that we've seen since COVID. So I guess I guess it's where where is what's the threat? I guess I still don't see the threat that the whole economy and the whole stock market is just going to crash for 5 years like the way these bears make it. I still can't really imagine that happening because just like you said, the liquidity, the guy managing billions of liquidity, he still is going to be managing that unless somebody runs in and starts telling me, give me this, because I need it or blah, blah, blah. I guess that's the last part is like why are so many people getting convinced that there's this huge correction coming in the whole market, and further, like the Fed's also just saying these things, right? And that could be just a way to, I would imagine it could just be a way to test the waters, right? I mean, they could change things anywhere. And so those are my last two questions. Then I'll get the hell out of here so other can talk. But you've been so helpful. Thank you.
I'm gonna address two parts of that. I'm gonna add two things to that question, I guess. One being again the narrative that the I don't know. And I've heard it from I think his name was Mark, and then the thought that the Fed is gonna flip on what they're saying now. I don't think that's not a way that I think that kind of viewpoint or narrative that they're sending mixed signals isn't true anymore. We were speculated before, like six months ago, basically, that they would be swapping, kind of being, they're just going to keep this thing going, right? The perma-bull thought. But at this point, they've given us a heads up for almost 5 months. No, like 4 or 5 months now that this rate hike and these kind of changes were coming Q1 or Q2 of 2022, and then it became Q1 of 2022 at the end of the year. Their last FOMC meeting, because inflation was gone from transitory now true. Like it's not just transitory; it's present inflation. So that's point one to say that the speculation here that they're going to flip all of a sudden on their head. They're in a corner. You could listen to fund managers and analysts speak on this, that they've driven themselves into a corner where they have no alternative, really. They can't let inflation rise further because it's already past the marks that they set, the 2% marks. It's getting closer to a 4, or even if you recalculate, or excuse me, if you take away their recalculation, it's somewhere in the realm of 8 to 10% inflation, actually. So because of inflation also where it's at, and then liquidity also going rampant and things like this, they're at a point where they can't go back on their word. And then the second point being that why is the correction? Why is there such a talk of a correction? Because for the last 2 years, like Rahul was saying,
bear market. Correction, I get, but bear market. Why expanded bear market?
Okay, expanded bear market. We'll phrase it that way then. So if you have for 2 years straight, right, from 2020 to basically the beginning of 22, so at least a year and a half of like Rahul mentioned, you have the Fed purchasing. Continually purchasing and adding in liquidity and making capital very easy to acquire, right? Have that injection into the markets. So if you have that going on for about a year and a half, and then you ease that off and then tighten that for the time after, that can be done. Let's say an example, 1 day, 2 days, 3 days. We did it for almost a year and a half. So now the process to undo what we did is going to take an extended period of time too. And in more likelihood, because it's going to be pretty much a non-beneficial to most companies and even lenders, mortgage lenders, and homeowners and things like that. The cycle that they would expand it likely be longer, or basically a longer period of time to make it easier to implement these changes. Right. That's why the rate hikes are planned for 2022 and then 2023 as well. They're trying to expand it over a period of 2 years to make it as slight and kind of ease it into the economy and for people. So that's why I'd say when you say extended bear market, it's because the process to undo what has been done if you did it rapidly, would cause a global meltdown basically, and everything would just halt basically. You tie that in also with supply and demand, supply chain issues and all that as well. And then now you have now basically not, an environment that's I would say anti-stock market. It's counterproductive to what makes the stock market go up. You have capital getting more expensive. You have supply chain issues and production being pretty much made worse around the world.
So, and you have a bunch of liquidity being pulled out of the markets, being invested in other places, like Rahul was saying as well. So again, you have all this being pulled away from the market and nothing really being injected in. So there might be moments obviously, and things like that, but the general direction that we're headed toward is generally now looking bearish, bear market, downtrend, however you want to phrase it. Hopefully that you guys please add to that, but that's kind of my 2 points that I had to directly kind of hit that question.
Of course, Jeremy Lin, go ahead.
Hey, man. Yeah, I mean, I think you make a bunch of great points. Just one thing that I think is important to note during this conversation is that, the FOMC minutes from today were from December. So there are some new data points that have arisen across the way. And I think one of the big occurrences that is like surfaced is, right, like the rise of Omicron and if it had any subtle effects on the economy. So the Fed's going to judge based upon changing data points, and they're going to use their proxies, usually PCE and CPI data, to confirm if inflation is actually, slowing on its own or if they're going to have to act accordingly. And obviously, as we've discussed, the majority of the causes for inflation right now are from the supply side of the, this side of the realm. So I don't necessarily want to make any conclusions just yet. I think that we are going to have to see that we have some Fed speakers later this week and CPI and PCE data later this month. So I think we want to see if the velocity of inflation is sort of naturally slowing on its own. Obviously the Fed is going to prepare markets for the worst case scenario, right? That's what we're seeing today. We're seeing markets starting to price in 3 yields. But if you actually look at the 20-year yield, it almost looks as though it's pricing in the Fed hiking a little too aggressively and having to potentially lower rates again in maybe, the late 2020s. So I think that's one interesting to keep in mind. And if the Fed uses this as a proxy to potentially pivot, within the coming months. So.
Yeah, really good question. We have a few more questions. Mahesh Saha. Let me bring him up. KT, are you back?
Sorry, I'm here. I was just retweeting some of what I was saying pre-market about that divergence and the call premiums that I was seeing with respect to the skew, Raul, and we see that in the futures now. I think I was doing some futures trade and I was just selling off some positions. But anyway,
all right, cool. Let's take the question from Mahesh. Mahesh, do you have a question?
Yeah, I think the discussion on macro markets is definitely interesting and important to have. But one of the bigger things I'm more interested about is the leaders. And like you said, the safety stocks in the FANG index. We saw a lot of shifting from the higher risk, higher PE ratio names into Microsoft, Apple, Tesla, like a lot of those names. But my question is, in previous QE cycles and when we've seen tightening, especially from a taper tantrum, we see that these safe haven growth names still take a hit. Is that largely because their aggressive growth strategies can no longer be funded because of, as Stocksman was explaining, the idea that capital is more expensive, or is it more so because there's just less inflow in the market overall?
So I guess to reiterate your question or make sure we answer it correctly, you're talking about when QT happens and how cost of capital goes up and how that affects these growth stocks or the leading stocks. Which stocks are you concerned with?
Leading stocks, because I mean the leading stocks are still growth stocks, just more
yeah,
safe
exactly.
because they've proven themselves, right?
I mean, you saw that reaction in November, right? You saw the minute Fed became hawkish. The first thing the market did is rotate into these the top tier stocks, right? So the FANG, Tesla, Nvidia, right? So the rates don't affect. Again, I think this is the key thing for everyone to understand. Rates don't affect these stocks. They don't affect Tesla. They don't affect Nvidia. They don't affect Google. They don't care about bond yields, right? These companies. I think I mentioned this earlier on Space. Since we've been running for like a few hours.
Just to clarify real quick, I think that point is very clear, like that fundamental sense. I think the question I'm asking more so is based on previous tightening cycles. We've seen that even these safe haven stocks do shed a good amount of their
exactly.
Market cap.
Yep.
And so what I'm asking is the macro events that we were discussing earlier, like the idea, like supply chain issues, like overall the job market and everything with that, plus the national debt, all of those things end up affecting the safe haven stocks because their aggressive growth strategies without the stimulus of the Fed is no longer a viable strategy, and it decreases consumer confidence in buying these stocks at these prices. Is that correct in assuming that?
To a certain degree, yeah. So the point you made about consumer, so there's a lot of different factors we're tying in here, right? We're not just looking at the rising rates. The consumer confidence that you just mentioned ties in direct inflation, right, and GDP growth. And you're right, quantitative tightening in general is going to have a massive effect. Whether it's not going to just be growth stocks, it's going to affect these leading stocks as well. And a lot of people are predicting that the leading stocks, when they fall, you're going to see a real correction, because look at just last year. I think they contributed the majority of the gains in S&P 500 and Nasdaq, right? So you're pretty much spot on. I don't even think you have a question. I think you kind of answered most of your question yourself. If you see quantitative tightening, and that's literally what we saw today, right? The Fed, I forget the guy's name. What's that guy's name from the Fed that yesterday gave potential hawkish comments on QT, Bakari or whatever his name is?
It was, I think, Kashkari. Yeah.
Kashkar, yeah, that guy. So he's one of the most dovish members. He indicated QT coming. That's what we saw in the minutes. These minutes are from December. I think the key thing to see is, do they actually follow through? This is something I actually mentioned earlier in the space, which again is a complete theory, but this also could be a potential gimmick move by the Fed to say, just drop the words QT, because the goal of what's the goal of rising rates, and what are they trying to do here? They're trying to curb inflation, number one. Number two, they're trying to normalize what's happened through a mass liquidity driven cycle into the economic markets. So they have to put some sort of response to inflation, right? So the key is that these are the few tools that they have, right? Is rates. They have the way they do quantitative easing versus tightening, and I think this is a big response coming from the Fed because of the massive push they've got internally from political leaders to respond to inflation, right? So I think that what they did today was, again, I don't know if it was a gimmick or if it was a fake out, but it would be insane for them to follow through with what they're saying, because I mean, I can't even imagine the markets with rising yields and QE becoming QT. I mean, who knows what would happen, right? I mean, I don't even think any of us, many of us, I mean, I started investing in 2013, so I haven't seen a true bear market. I think the last one was 08, 09 when I was still in college. I remember it, reading about it, but I wasn't actually investing through it. So I don't know if you had a question around QT. I think you said it does affect the leading stocks. I mean, it affects the entire market, so you kind of hit that as well. So I don't know if anyone else has anything to add to that, Jeremy Lin or Stocksman.
Yeah, if you want to see what QT does, you can scroll back again to 20, was it, yeah, 2008, 2001, I believe. You can look at different areas. I think 2009, I believe 2009. You could go back and scroll and see what it does to the markets, including, if you're trading view or anything like that, or TD or whatever. You can scroll back and see what it did in those years. You just find the exact date of it, and you can see how it affects major stocks. It affects the entire stock market. But again, we have to. The minutes are from December, so going forward, the only thing I would say again that could alter, directionally, the Fed, in my opinion, again, this is all opinion based, but I think it's pretty convincing because they've been giving the heads up that it's coming, that these kind of moves are coming. The only piece of data that I think could slow them down or stop them from going straight quantitative tightening right now, which either way, I think that is going to be, I think that's an overreaction. A lot of people are reading too much into that, but it's going to be the loss or the, people, 4.5 million people quitting their jobs, which was released on Monday. So that piece of data that was, just pushed out. I think that, considering these minutes are from December, that from this week is going to, that could have a definite effect on their next meeting and their next, pretty much the next minutes that we see and get released. That's the only consideration I have. I think that if you want to, you want to be puffing the hopium a little bit and hoping for a lot of things, that's your one kind of hope. That the job market has been a main talking point of Powell and an emphasis of his, that he wants to see jobs come back. But that it's kind of a blow to the armor that the whole the narrative that the job market is rising. So that could do something, I guess, to slow it down, or at least stop the quantitative tightening conversation, which would be, I guess, helpful. But overall direction is pretty clear cut with the Fed and where they're looking to, what points they have to address very soon.
I think considering the job number stuff, it does definitely sense that would potentially alter the decisions to some degree. I'm personally of the mindset that the Fed is pretty set on what they have to do now, just because they've attempted to hold this market and recover as best as they can, and now it's the process of unwinding it. But the related to job markets, do you think that the job numbers and the quitting numbers especially affects the Fed's decision that much, given that they've seen the job market not do incredibly well because of QE, throughout this cycle especially?
Yeah, another good point. I think we saw a record amount of people quitting in November, right? Like 8.3 million or something.
Right.
and then another 4.5 million in this last data from this week.
To be completely honest, Smash, I honestly don't know if Fed has the perfect answer to any of this. I think they're just playing around with the tools that they have, and they're just testing what they can do. I mean, there's limited things they can, right?
Yeah, definitely. I just like I was went through like a really big just start like scanning session last night, going through all the big names, small names, everything alike, and it's like kind of wildly scary how much these bigger names can break if they do break. Like Amazon, Google are all threatening major trends. The Hang Seng Index in China is threatening a 10-year. We have global PMI numbers coming down as well. Like there's some huge macro pressure that's really facing the market, and I think expecting the Fed to flip bullish to avoid a potential downturn now seems a little bit hopeful.
Yep. No, I agree. I don't even think you have a question. You should just stay up here and help us answer some questions.
I was also going to add a little bit of a tidbit too, just for for keepsake and something for people could take away too. It's that the whole goal of investing, or at least trading. You say investing is a different thing. It's more trading is capital preservation. That's the underlying goal. If you have capital, you can keep playing the game, right? So if you're looking ahead and you've been buying the dip and doing the retail trading way basically, but you're in these spaces and you see today, you see the news, now you're reading into it, you're understanding more of what's going on. If the goal is capital preservation, right, then playing the Fed and being speculative on it, if you were a betting man, you'd probably be leaning towards them tightening up and things. Direction is pretty much defined to be a certain way, even if it doesn't happen as fast, right? Going bullish, going long right now, getting long calls out of the money or something like that. Protect my basic point is just protect your capital, and even if you have to wait a month, if you wait 2 weeks, if you have to wait 2 months, whatever you have to wait, if you have a grand, 10 grand, whatever it is, and all these stocks get beaten down to hell, and it takes 2 months, 3 months, it doesn't matter how long it takes. And you see these opportunities and you start to see the narrative in these spaces on Twitter, in the markets, in the macro, whatever you're looking, wherever you get your news from, start to truly flip, then you can make good money versus trying to speculate and fight the trend and guess what the Fed is trying to do. So, get more experience. I would say get more experience. And if you have to sit on the sidelines for a little bit, or at least just, have a little patience, that could be in your favor. Use that time to get better and learn more about technicals and about fundamentals and really better yourself as a trader, as an investor, while the markets are bad. Because while the markets are hot, people just want to be in the markets and participate. While things like this are happening and you see things getting sold off, this might be, this couple days where it's just kind of dipping. Use this time to actually get better. Watch some videos. Go to YouTube. A lot of some people may have courses. If that's your thing, go, start diving in. Just keep your capital, preserve it, learn, and again, all the people up here, me, even Mahesh, I know he's done a lot of reading. So Rahul's done a lot of reading, I'm sure. Get better, man. All the retail traders, get better, and it'll really benefit you in the next couple of weeks or months when the opportunities really, really start to set in and things are looking really cheap and there's a lot of oversold stocks. You'll make a lot of money in those moments.
Yes, Tony likes to
I just
say
want to
get better.
focus just one word: capital preservation. Don't fight the trend, and keep yourself informed. That's it.
Live to trade another day, man. Perfectly said. Chapur, did you have a question? I think he's connecting. Avi, Avo Deals, are you here? Shout out Sagar. What's going on? We have a few more just questions that are not stopping today. Jeremy Lin, didn't you leave and come back? I think I've been on the whole time, 3.5, 4 hours.
Yeah, I left the office, headed home, and then kind of hopped back on. So thought I'd check it out. Why not?
Of course. Imran, go ahead. Imran, did you have a question? Imran Mubarak?
No. We'll actually continue right now.
I guess you just came to say hi. Hi, Imran. Chapur, did you have a question?
Hey guys, this is really nice. It's very, very informational. The topic is really good, and people who are talking is really knowledgeable. I have I don't know. I have this thought. I mean, maybe at this point, either his fund or a retailer who is selling most of the stock, mainly the growth stock, is down 30, 45%. And if they didn't buy this stock maybe 200 days ago or whatever, most of them, either definitely selling in loss, right? I mean, that means they're thinking it might go further down, right?
You in the middle of your question, you kind of chopped up and it cut out a little bit. It was you mentioned growth stocks, them selling it, and then I couldn't exactly hear what you were your final point of it was your final question.
Oh, sorry. Can you hear me now better?
Yes, yes.
Oh, okay. My question is like, at this time, I mean, like most of the growth stocks is almost down 40, 45% or whatever. Most of them like below 200-day, moving averages. So people are selling right now. If they didn't buy the stock, 200 days ago or whatever, they are definitely selling on loss, right?
And most likely, yes.
Right. So like, if the selling continues, that means like people have this perception, what, this stock might further go down. That's kind of a little scary though. But just a thought. I don't have a question. As you guys have any idea, any thought or whatever?
I don't think we stabilize unless there's a more. I don't know. It's a catalyst, right? I think I've been saying this the whole space pretty much.
I mean, like someone that looks at stocks from a valuation perspective, I would say it was quite scary for them when they'd made the run up to their highs, back in like Q3 last year, right? Because then a couple of these companies were trading at like 100 times earnings, which most likely would never be achievable. I mean, unless we have a drastic macro shift, in the next like 20 to 30 years. But that's why even though these companies are down 40 to 50%, you still can't look at them and say they're a good bargain for their buck, because it all comes from a multiple perspective basis, and when margins decrease due to higher yields, there's going to be multiple compression across the board. So I think that's just something to keep in mind here.
I'm also going to add. Oh, go ahead. Go ahead.
Yeah, really quickly. I think the idea of selling at a loss is like a misconception, largely because I think what Stockman was explaining was the idea of playing defense when it comes to like fewer opportunities in the market. And the idea of playing defense is taking a loss and recognizing that you take that loss before that loss becomes unmanageable. And like a good example of this, we've already seen in a bunch of names. Like if you look at like Peloton, for example, that massive gap down on the news, and a lot of people were like, "There's no way that dip, lasts." And we saw a short relief rally for like 3 days. And then since that dip, it's down about 46%, if I recall correctly. So the idea isn't that you're taking your loss and selling it at a point where, it's down 40%. It seems kind of like you're selling at the bottom. The bottom isn't, that quick to reach when the selling pressure on macro things is not even considering like Pinterest, Peloton, all of these like high growth multiple names that largely were, part of the rally because of so much injection from the Fed.
Great. Hopefully that answers your question, Shapur.
Yeah, great. Thank you.
I'll just say one last thing just about it generally, that there are just amongst the herd of growth names, amongst the herd of tech names, there are still some golden gems. For example, I have one that I'm watching very intently is like Snapchat, right? Because Snapchat has a connection to AR, metaverse. They revenue. They're going to bring shows like full on shows and really expand their platform and make an ad revenue, all that kind of stuff. So there's like still some gold amongst the names, right? But you can't take away from the macro pressures and this changed environment. But you can still keep your eye on very certain names that still have good fundamentals underlyingly. Still, regardless, that's still now a very key point on any name you want to own. The fundamentals matter. So let things sell off, and there will be some opportunities, but it's not going to be as widespread as was mentioned, like the Q3, for example, where you saw green across almost every mid cap you opened up was just day by day running 10%, 20, 30, 40, just over a course of 2 quarters. Basically, majority of mid cap names were up somehow 30 to 50% in 2 quarters. So that's not going to happen. But there's still some really rare opportunities and some real companies amongst these tech names that if once you get some fundamentals in and they're considered growth names, they're still good companies and they're still going to be tradable, but you just got to be patient and if you don't know what dollar cost averaging is, that's what a good strategy when it comes to some of the names that you may want to, but the environment is not perfect for it. So just a little bit of I know I'm Mr. Bearish and Mr. Don't fight the trend, but this is just my little tidbit of asterisks of like there is still some potential of growth companies, but you got to be very, very, very specific with it. And it's not as liberal as it was in the last year and a half, basically.
No, 100% agree. And I think it's a good way to call it. I think we went on for almost 4 hours now. Thanks for everyone that tuned in. Hopefully this was helpful. We covered a ton of stuff from the Fed to macroeconomics to growth stocks to individual questions on different stocks. Again, none of us are perfect. None of this should taken as buy, sell, hold advice. It's just our personal thoughts and research. We're all trying to get better at this, and as a Stocksman mentioned earlier, preserving capital and continuing to understand the markets better and adapt as much as possible. So if you find these things helpful, if you find these spaces helpful, give the whole panel a follow. Some great people on here speaking. Stocksman, thanks for joining. A great contributor today. Give him a follow. Give Jeremy Lin a follow. Luca, you running with the money. Avo Deals, he's on here pounding the table, of course. I host these spaces quite frequently, so if you want to know when they are, I mean, if you're following us, you'll see our tweets or comments on these spaces. Our next one's tomorrow morning, tomorrow afternoon, 12 p.m. Eastern with Brian Feroldi. Another one next week on cybersecurity. I tweeted that about an hour ago, so you'll find that on my feed. But thank you. Thanks, everyone. And I don't know if anyone has any closing thoughts. Avi, I don't know if you're there, but I think it's been a great space.
Appreciate you, brother. You're a real trooper for doing this for 4 hours, man. I'm just going to say, if you've been here the entire time, kind of coordinating it, you're an actual boss trooper. Appreciate
Yeah, I think I've been here the whole time. Jeremy Lin knows this. I think people have gone in and out, but I've been here.
Appreciate you, brother. Follow this man. He's a real one.
Yeah, these spaces are just, absolute great education for any, whether you be a beginner trader or an experienced trader. Some of the speakers that come on here are like extremely well diverse, whether it would come to day-to-day trading or macroeconomics. I know we saw that today with like Jay, like the stuff that man knows is just worldly to me. So I truly cherish these spaces, Raul, and I appreciate you having me on.
Yeah. Thanks for coming on. Go ahead, Luke.
I guess to close out, a lot of people are trying to predict what is going to happen in the coming weeks and months. Trying to predict what the Fed is going to do, yada, yada, yada. At the end of the day, I think in this type of market, you just need to be really agile, be patient with things. Only take the best setups you can possibly find, trade your plan, and at the end of the day, maybe even scale down. You don't have to be all in the market all the time. Or you don't even have to be in the market sometimes. I ended the day with a crap ton of cash on my long side, and I've had that cash sitting there. And then I don't have any trades on going into tomorrow, and I haven't really taken many trades in the past month. And that's simply because of just how the market's been. Sometimes the market just gets difficult, and you have to let it just work its issues out. But either way, taking a look at levels real quick on IWM, going into the back end of the week, I am watching for IWM to be holding that 210 zone. It's been trading within a base for quite a long time, and if it breaks down through that 210 area, I think you could have some major issues there. On Triple Q, once again, watching that 100 SMA, and then also on SPY, watching that one SMA. If we break down between under those levels, I think you could see some significantly more downside down to the 200-day moving averages, but who really knows? But very quick within these markets, no major positions. I really don't think you want to be like going long anything with the size at this moment. You really don't have to be risk on all the time. Typically, it's pretty darn safe to simply be very conservative when it comes to going risk on. I only tend to go full risk on when the markets are excellent in an upwards pattern and consistently bouncing on a bottom end trend line. And right now we don't have that. We've had quite a long bit of time here with some consolidation, but those are kind of my thoughts right now. Either way, I just want to say thank you to everyone who's been listening to this space. The Pound on the Table team appreciates all the support and all of you listening in, and we have had phenomenal speakers as well. Give every speaker we have had up here a follow and that are up here. It's very valuable information. Everyone comes on here and just willingly wants to talk the market and share their knowledge, and we all get to be students of the market, and it's absolutely phenomenal. So once again, continue to be a student of the market, take the lessons as they come, and let's see what tomorrow brings. As I always say and normally tweet in the morning, it's another day of opportunity, another week of opportunity, and another year of opportunity. So let's get it.
Awesome. Great stuff. Thanks a lot, everyone. And thanks a lot for everyone joining in and speaking as well. Really appreciate you guys. Thank you.
Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move. Big money.